So sorry guys, there's some issue with the streaming. Okay, so what is the answer for this? If we are talking about future value being 1000, and then after 1 year 8% is the rate percent that is applied. Okay, so if you want to calculate the future value, right, sorry, you have the future value, want to calculate the present value, then how are you going to calculate? Present value is nothing but future value divided by 1 plus r whole to the power of n, isn't it? So this is how we are going to calculate. So yes, almost all of you have answered it absolutely right. So here we have the future value 1000 divided by 1 plus r, 1 plus 0.08, 8% has to be written like this, and year is 1. So if you do this division 1000 by 1.02, you are going to get an answer of 925.93. okay, moving to the next part. Please try to answer this one very quickly. Yeah. So I hope things are clear over YouTube also. You can please tell me in the chat box, right? So let me tell you, people who are on YouTube, this is a live demo session of the finance subject as far as your RBI Grade B phase 2 exam is concerned. Okay, preparing this part is really important because finance is slightly complicated, so just moving about it after the phase 1 would be difficult for you. So we are providing these classes. You can be part of these classes by clicking the link given in the description of this video, or you can visit edutap.in and be part of our live crash courses, gold, silver courses. Okay, so that you enroll into this course and you are part of this particular live sessions and other live sessions. Okay, so I would request people on YouTube also to actively participate. Here we have which of the following is not an example of annuity. This is a question of RBI Grade B phase 2 2017. I asked you this question previously also, so I hope it is very clear to all of you that here D is the right answer. Monthly rental payments, periodic payment. Quarterly income, that is also periodic payment. Semi-annual interest, that is also periodic. One-time lump sum payment for a car is not an annuity payment, so D should be the right answer. Moving ahead, suppose you invest 5000 at the end of each year, wherein you are investing 5 for the next 5 years with interest of 5%. What would be the total value of the money at the end of 5 years? Assume future value of annuity factor of 5% for 5 years to be 5.52. What should we do? Can anyone tell me very quickly what should we do and what is the right answer over here? Yes, most of you have given the right answer. What are we required to do? Whenever you are required here, what is required? Assume future value annuity factor is given over here. The present value is given, right, 5000, and this is annuity payment that is being done in which way? For 5 years continuously, every year this is done at 5% interest. Okay, so in that case what is going to happen? What will the future value be? Future value is nothing but present value into present value factor. Okay, so we can say like that. Okay, or we can call it, to calculate the future value we have this factor. What factor is given over here? 5.52. so 5000 into 5.52, if this is multiplied, then we are going to get the answer as 27,600. This is how our we have present value factors, future value factors, annuity factors also. We discussed all of these things, and so yes, we will be doing the calculation in that manner, and this makes a life really easier as far as approaching such type of questions is concerned. This is a direct RBI Grade B question of phase 2 2017, so you can see directly they have given the number. Okay, they have given this number. Of course, what we need to do is some of the formula we will definitely have to, at least the present value future value formula, please try to learn them. If at all any question comes, we should not be in a position that we are unable to answer, so please try to do that. Here again we have another question, which of the following is a characteristic of bond and not a characteristic of equity? Okay, so this question actually helps us in differentiating between debt and equity. So bond is a kind of debt. Okay, we saw some of the differences, we'll see further differences later on. I would request all the people over YouTube also to please participate in this thing. Okay, please try to answer these questions, and further ahead also you can please let me know the answers. Yes, Ashwini, senior answer, very good. Yes, the correct answer over here is B, fixed income. Okay, all of you have answered it right. What can we say? Bond is actually a debt instrument. It is called the debt instrument. And then if we talk about equity, what are the differences between them? And for that sake, we'll also see we have also seen some of the properties of bonds. So debt, if we talk about debt, the first thing that we know, we have fixed income coming from debt. debt is like a income. And debt, if we talk about that, it is an obligation. Okay, if compulsorily the payment has to be done. On the other hand, equity, what can we say about it? Here, do we have fixed income? No. Okay, income is not guaranteed. Income may be variable. Okay, or we may not have, or zero also. Okay, we may not have any income or even negative loss also. Okay, so it is totally variable. That is the main characteristic. There is no obligation over here. Only thing is, the main thing with equity is that there is ownership that is provided. Okay, ownership is given. Equity, the main meaning of equity itself is ownership, right? So we'll talk about equity. We have the chapter equity market, debt market. Nothing to worry, but basic characteristics must be known. So bond. Okay, in that sake, if I ask you dash risk, okay, which kind of risk is there as far as debt is concerned? And if we talk about equity, what is the risk, high or low? Can you just tell me very quickly in the chat box? Yes, very good. Income is directly proportional to profit made by the firm. Yes, in equity. Wonderful. Okay, so debt, we have low risk because here the payment is compulsory. It is an obligation. You definitely have to do. Debt is like borrowed. Okay, borrowed money. This is borrowed funds. Whereas if we talk about equity, it is sharing ownership with someone. Okay, sharing ownership. Whatever happens with the company, you are also liable for that. So here the risk is high because I am not in control of the company directly. Okay, we'll see very wonderfully when we talk about when we talk about this in the equity chapter. Okay, so stay tuned for that. Okay. Now moving ahead, here is our leaderboard. Okay, so we have new entries in the leaderboard. Yoganshi, day before yesterday, she was on YouTube. Now she has jumped directly into the leaderboard and to the top position. So Yoganshi with 10 points is at the top. Kashish and Pragati are at the second position with 7 points. Balkrishna, congratulations, 5 points. Riya, 3 points. Piyush, Suraj, Krishna, all of you are at 2 points, and others, Mansi and Monica at 1. And every one of you are participating really well. I hope more of you try to answer first and enter into the leaderboard. Arey sir, ye first wala super computer ye sab kyun kar rahe ho? It is because you also need to be quick while answering the questions in the exam. We have read the entire concept, then when the question comes, obviously you should be able to answer it quickly, and just to create a slight competitive environment, we have done this. Okay, no offense to anyone, please do not mind it. Other than that, we also saw that on YouTube there was active participation. Pradeep and Right Strike, they were answering well. So on number 1 we have Pradeep and then Right Strike. Now moving ahead, we will discuss the rest of the topics in the bonds market. Let us quickly move into this. Okay, how many of you remember what basically bonds mean? Okay, so if you talk about bond, the main thing that should come about is that it is a debt instrument for sure, isn't it? Then we spoke about various features of the bonds. Okay, do we remember any of the features? Firstly, we said if you look at the bond paper, there is some number written over here, 1000. What is that? That is called the par value or the face value. And then we also said that there is some interest that is paid, isn't it? This interest is actually called what? Coupon. Yes, absolutely, all of your answers are absolutely right. Coupon rate. Okay, it is mostly called coupon rate, and this coupon rate is always calculated on which basis? Okay, is it the par value, current market price, or any other price? It is always calculated on the basis of the par or face value. Please remember that thing. And other than that, we have the bond might be paying 1000, but it might be trading, it might be the current price of that bond might be 900. So current market price here, if we say 900, so bond also has some maturity. Okay, there is some time period after which it will mature. So we can say like 2 years, 3 years, that is the maturity, right? So all of these things are there. Apart from that, there is risk also involved with the bond. Okay, if at all, if I say there is the bond is issued by Reliance. Okay, so can we rely on this bond issued by Reliance? Okay, so is the risk high or is it low? What will be the credit rating? Okay, can you just tell me? So the risk is low risk, and credit rating would be what? High. And what about the return on this? Return will be low. Okay, now apart from this, if we have XYZ company, some company we don't know about it, what is the risk over here? Can you please quickly tell me? Right, it is high, whereas the credit rating will be What? Please tell me. And what about the return? Okay, return will be, credit rating will be, sorry, low, while the return will be high. They have to make it very attractive. Now moving ahead, we spoke about a few all of these things in the introduction. Now we need to move towards the different types of bonds. Okay, quickly we actually went through a overview of this. We will go deep into this and try to understand each type of bond. Okay, let us try to understand. The first one is a government bond. Okay, why do we call it government bond? The name itself says the term government over here, it means that it is issued by the government. Apart from that, we have the term bond also. Okay, please remember bonds, as we have seen, there are two parties in the bonds. Okay, can anyone tell me what are these two parties? First party, if we say who, the party which is actually issuing that particular bond is called the issuer. Any other name for issuer? Can you tell me any other name for issuer? Right, can you tell me what is the other name for issuer? Or in is there any other relationship that we can say the issuer has? Yeah, borrower, we can call them borrower. Okay, because they are the persons who are borrowing, borrower or debtor we can say, who actually has the debt on them. While we on the other hand, we have the bond holder. Okay, bond holder, and this bond holder is actually also called as, yes, investor or lender, right? So you should be very clear when we are talking about issuing the bond. Okay, so company like Reliance actually we said in the example has issued the bond. Here government is actually the issuer of the bond, so it is called government bond. Simple. Bond in the sense offering fixed interest payments, and it is offering fixed amount of income. Okay, so it is a bond. All the features will entail what we have discussed already. So it here what can we say, it is really very low risk bond. Okay, the safety is really high. Why can we say this? Can anyone tell me the reason? Government bonds are said to be very high safety. Of course, government backing is there. What does government backing provide? Okay, backed by government, definitely. What does government backing provide? Government backing in the sense, what does it provide? What is the yes, assurance, high rating, default will not happen, government will not cheat, stability is there. Also, government is an entity which has the right, or which can direct printing of currency, all of these. It can manage the money in the economy. It is the entity that manages the growth of the economy, everything. Okay, it is in control of the entire economy. So obviously we can be very much assured that if government has issued this particular bond, it will be very safe. Now, based upon the maturity, we can classify this particular bond into three kinds. Okay, the first one is called bill. Okay, maturity in the sense, what is the tenure of that particular bond, right? So here if we see, we have yeah, we have the bills are what, less than 1 year. So less than 1 year, if we have any government issuing these bonds, they are called bills. Okay, we must have heard about treasury bills or T bills. Okay, we'll talk about T bills further as we move into the debt market, but for now less than 1 year they are called bills. Apart from that, we also have note. Okay, certain government bonds which are 1 to 10 years, they are called notes. Okay, what are they called? Notes. Please remember, now more than 10 years they are generally called bonds. Okay, now these two together are sometimes called government securities. What are they called? Government securities, or GSEC. Okay, they are called like this, GSEC, right? So these bonds are actually issued by different governments. We cannot say only the central government will issue, or only the state government will issue, or the municipality or the district whatever government is there, that will only issue. Okay, so different governments issue. The bonds issued by the central government are of two kinds. Okay, central government issues two kinds of bonds. One of them is the short term bonds. Let me just give you a little idea of that also. So short term bonds are generally called treasury bills, and as we have seen, long term bonds are called government securities. In government securities we have notes, and sometimes greater than 10 years they are called mostly bonds. Apart from that, we also have state governments issuing the bonds. Okay, we'll discuss about them in detail later on when we discuss the debt market chapter. State government only issues long term bonds. Okay, only long term bonds. Please remember this for now, only long term bonds, and these long term bonds are called state development loans. Okay, so they are called SDL, right? State development loans. Now both of these these levels we have seen. But apart from this, there are also municipalities that issue the bonds. Okay, so these are very special bonds. They have a special name also, which we'll try to remember. Now moving ahead, based upon the issuer, right now we are discussing two kinds of bonds: municipal bonds or muni bonds. Okay, very specific devotional kind of name. Then sovereign bonds, which are also the bonds issued by the central government mostly. Okay, so that is the thing. Now we will try to differentiate between both of these and also see some of the features of the muni bond and the sovereign bond. Okay, so this muni bond, municipal bond, is actually called muni bond because it is issued by the municipal corporation, or it is like the district or the local area government. Okay, that is going to issue this particular bond. And apart from that, it is called bond. Again, please remember, I am reminding you again and again, because this word bond, whenever you hear it, you should be able to give a phrase to it. As I said, always in finance you should be able to give a phrase to each and every term that you see, then you have understood finance. So bond means what? Offering fixed interest payments or fixed income. So that is what the meaning of bond is. What is the need of coming up with such bonds? It is like funding, isn't it? Whenever a government wants to go for we can say for Reliance it is expansion, but for government it is infrastructure development. It is like coming up with new initiatives. It is like going for new schemes, providing benefits to the people, doing welfare. Okay, so all of these things are the requirements. So mainly the municipal muni bonds are given out so that infrastructure projects can be handled in a proper manner. Okay, infrastructure projects can be funded in a proper manner. Okay, so that is the thing. And they are also for the same reason they are sometimes called revenue bonds. Okay, why are they called revenue bonds? Because whenever we say these bonds, the bonds are used in developing infrastructure like what? Bridges, hospitals, airports, buildings, right? Then whatever revenue is generated out of them, like over bridges, or when you cross between states, there is some road toll that is to be given. When you move over the connecting highways, state national highways, you have to give the toll. You know about it. So these toll actually provide what? Revenue. And apart from that, in the hospitals which the government has built, the user fees are there, airport user fees, lease rents of these particular buildings are there. All of them actually generate revenue. Now how will the payment of the bond, return payment of the bond be done? It will be done by the help of the revenue that is being provided. Let us say I and all of us, all 50 of us have actually invested in these bonds. So how will we get a return back from the revenue that is generated out of the infrastructure that has been established? Okay, so that is why they are also called revenue bonds. So in exam they can also ask you related to revenue bond, answer which of these is correct. Okay, so you should be able to answer that. Okay, so that is the muni bond. Now coming to the sovereign bond, sovereign means issued by the national government. Like if US government issues, that would be in terms of US dollars. Indian government issues in terms of Indian rupee this particular bond. So that is called the sovereign bond. Now bond, because it is offering fixed payments or fixed income, again the need is for financing infrastructure projects, and for the central government many a times it also has to finance its deficit. Okay, what is the deficit? For now you will learn in your ESI, but for now I would like to tell you that let us say the government of India has fixed expenditure of 10,000, but somehow it is only able to earn income. The income of the government of India is only 6,000. So the remaining part, which is a compulsory expenditure that has to be done, from where will this amount come? So this is called the deficit. Okay, so to finance this deficit is to be financed from somewhere or the other. It is like जो कमी हो जाती है हमारे जो एक्सपेंडिचर को फुलफिल करने के लिए, राइट? तो दिस कमी, और वी कैन से द अमाउंट विच इज not available with the government, right? The income which it could not actually earn to to perform the particular expenditure, that is called the deficit. Okay, so for what is the deficit over here? 4,000, isn't it, in this example? Yes, failure to generate sufficient revenue to finance the particular expenditure. So that is called the deficit. Now is there any risk entailed as far as these bonds are concerned? The risk is very low. Sovereign bonds specifically, the risk is very low because they are backed by the government credit. Absolutely. So these sovereign bonds are actually issued in different currencies, like there are two kinds in this also. The first one is called the domestic sovereign bond. Okay, bond which is issued within a particular country. Like in India, if you issue the bond in rupees, so that is called domestic sovereign bond. It is mainly targeted towards the Indian investors. Okay, Indians will only buy that one. Okay, so that is called the domestic sovereign bond. Apart from that, we also have the foreign currency sovereign bond. Okay, I'll take your doubt. Okay, I'll take your doubt in a second. So foreign currency sovereign bond. So Indian government can also issue a foreign currency bond. Okay, dollar based bond. In that, what it has to do, what will happen, let's say if the Indian government issues a dollar based bond, in that case this dollar based bond will go and the revenue will be coming in the form of dollars. Then Indian government has to convert that dollars into rupees, and then it will be able to utilize in India. Do you agree with this on this point with me? So here what is there, we have a currency risk. Okay, I have written currency risk. Here there is no currency risk, no conversion of money. But on the foreign currency sovereign bond, there is a currency risk. You will have to convert this dollars into rupees. Let us say Indian government expected $1 after conversion, it will be 90 rupees, right? But when it has received this money, it has received, and then Indian government saw that the exchange rate has varied, because exchange rate is very much volatile. I hope you know it has varied to 85. It thought it would get a profit of 90, but it is getting a profit of 85 only. Okay, so that is why we will say that the foreign currency sovereign bonds entail currency risk. Yes, are there any doubts here? Yes, is sovereign bond issued in foreign currency? Yes, I am telling that, explaining the same thing. What is the difference between domestic and normal bonds issued by the domestic sovereign bond and normal bonds issued by the government? There is not much difference in both of these things. Okay, domestic sovereign bond is like to differentiate that it is not a foreign currency sovereign bond. Okay, so that is the only thing, Madhav. Is that okay? So we are issuing the bond in India in Indian currency. We'll call it domestic sovereign bond. Domestic term is added just to indicate that it is mostly directed towards the Indian investors, because they will only buy in rupees. Why would a foreign entity buy the bond which is issued in rupees? Okay, sometimes they do, but yeah, mainly it is directed towards Indian investors. Whilst foreign currency sovereign bond, who will buy a bond in India that is issued in dollars or any other Chinese currency, right? Mostly we do not. So it is directed towards the audience, which are the investors who are outside India, right? So that is the reason, this differentiation. Now apart from this, we have other kinds of bonds. Can we say that a normal sovereign bond and domestic sovereign bond are the same? Yes, they are the same. Okay, what is normal sovereign bond? Tell me what is normal sovereign bond. I just said sovereign bond can be classified into two kinds. One is domestic and the foreign currency sovereign bond. Okay, any government bond, in the sense it is, if it is issued in rupees, we can call it domestic sovereign bond. It is just a option to the government. It can issue in foreign currency also. If it does, it is called foreign currency sovereign bond. Okay, Pragya, is that okay? And Madhav and all, is it okay? Krishna, yes, thank you. Is it fine? Sovereign bonds and government securities are different terms. No, they are the same thing. Sovereign means issued by the central government. Okay, please try to understand the sequence of explanation. Initially I just said government bond. Okay, government bond means any government can issue. That is a broader term. Now coming to sovereign bond means Indian government only, right? In Indian government has two options, domestic currency or foreign currency. So that is foreign currency. Okay, Tripathi, is that okay? Yes. So moving ahead, audio, is there any issue? Please tell me. Now moving ahead, if we talk about corporate bonds. Now corporate bonds, as the name itself suggests, can you guess what is this corporate in front of the bonds? Yes, very good. This is first thing, it is issued by the corporations in the sense companies. Yes, mostly they are sometimes also called debentures. Okay, let me also give this term to you. They are also sometimes called debentures. They directed towards the personal profit of the companies, not towards the broader economic development. Okay, so yeah, economic development or financing the public, the government things. Okay, it is not directed towards that. So corporate bond, in the sense corporate, it is issued by the companies, it is not issued by the government. Also that, okay, the negation should also be understood. Apart from this, we have bond. Bond means offering fixed interest payment. Again, please remember, recall, fixed income is coming from that. The need for such bonds is to fund the operations expansion or funding funding daily operations or funding the expansion of the company, right? Yes, expand the business. Very good. Voice is breaking at some point. I'm so sorry. I think there's some internet issue. If there is any if you haven't understood any point, you can please ask me again, right? So I'll just check that. So is there any risk? Yes, there is definitely risk, because it depends upon the financial health of that particular company. As we said, we have XYZ company and we have Reliance. So obviously Reliance is somewhere on which you can definitely rely. These bonds are on which you can rely, because it is a big company. Almost in every sector Reliance has its ventures. But if we talk about XYZ company, we don't know about it. So that is why the risk is very high. Depends upon the company. Yes, definitely if there is a comparison between corporate bonds and government bonds, which one would be more risky? Can you just tell me, C or G? Which one would be more risky? Can you just tell me very quickly? C. Okay, now moving to zero coupon bonds. I also gave you previously, I told you about this zero coupon. The term itself says there is no interest payment that is done over this particular bond. Okay, zero coupon. Coupon payment means what? There is interest payment that is being done. Remember, we spoke about 1000 rupees being the par value. This is bought at 900, 9% interest. So zero coupon bond would look something like this: 1000, and let's say you could buy at 800. Oh, this is not there. Okay, the interest payment is not there. So you just buy it at 800, and at the end you will be getting 1000. That is the only profit that you are going to get. The difference between both of that, let's say 200 rupees, is the profit that you are going to earn, and the payment would be one time. After the maturity, let's say 5 years, 10 years, 2 years, whatever, you will get this 1000 rupees back. Okay, that is called the zero coupon bond. Very clearly, the name of the bond itself explains everything. There is no coupon payment. No such coupons are there in that bond. No regular interest payments. Okay, this zero coupon bond definitely has to be issued at discounted price. Do you understand the meaning of this particular term, right? So there is any difference between debentures and corporate bonds, or they are the same? Yes, it is the same. So I said we can call it debenture also. Private companies issue, we call it corporate bond, or we call it debenture, right? So here we have this being issued at a discounted price. What does that mean? If at all, let's say we have a particular bond, and this bond has, as I told you, 1000 rupees is the par value, so it is issued at 800 or 900, then we will call it is being issued at a discounted price. We said discount. What is the meaning of discount? CMP, current market price, is lower in comparison to what? The par value, right? Then we will call it discounted, right? Do you remember? So 1000 rupees is what you will get back, but you are buying it at 800, then that is called the discounted price. Now moving ahead, we have the perpetual bond. Okay, do you all remember what is perpetual bond? Yeah. Okay, we'll talk about debentures in detail. For now, you can think that corporate bonds and debentures are almost the same thing, right? Yes. So here perpetual bond is nothing but there is no maturity. It is also called console. In the exam, question has come. They didn't ask you what is perpetual bond. They directly asked you console. They said, they just gave console, and they have given so many statements. So of course we should know the other names also. It is also sometimes called prep. Okay, it is sometimes called prep, right? So these are the other names. And here perpetual means there is no maturity date. Okay, what does happen in this? Here they do give some par value, and they say 10% interest on this, and they say you can buy it at 900, let's say. So this 10% keeps coming at regular intervals of time. Let's say every 6 months you are getting 10%, which is 100 rupees. Every 6 months you are getting 100, 100 again and again, like that. Okay, it keeps coming. And this is what is called the perpetual bond. There is no maturity at all. Okay, so how is the company going to actually fund this particular thing, or how is it going to return this interest? So these perpetual bonds can be redeemed at certain times. Okay, there is no option for redemption in general. Redemption in the sense, stop that particular bond, stop the interest payments, cancel it out, and finish the business. Okay, so anyway, so perpetual bond is like it has no maturity date, but whenever the company wants to stop the interest payments, it can do that in certain kinds of bonds which are called callable bonds. Okay, so we'll talk about them also. Bond means offering fixed interest payment, and here the term is forever. Okay, generally it is issued forever, that it will keep offering you interest payment. payments, and you just need to invest in that. Obviously that would not be something that any company would be able to give the interest payments again and again, but yeah, this is a kind of bond wherein the maturity is very high, practically speaking. So the drawback is it is not redeemable. Okay, we cannot stop it in between, right? It cannot be stopped in between. It keeps moving in the market, but mostly companies issue it in the form of a callable bond. Okay, issue it in the form of callable bond. We will see what is this callable bond. For now, perpetual bond is this, that there is no maturity. Okay, there is no fixed maturity for it, right? Yeah, so there's this example given in United Kingdom 1932. There was this perpetual bonds were issued by the central government, wherein they called all the people to please invest in these perpetual bonds, so that whatever wars are going on, these wars can be funded. Okay, the government itself wanted some money, so all the wealthy people of UK, they invested in these perpetual bonds called console bonds during World War, and then at that time they funded the entire all of the defense activities by the help of these bonds. Okay, so this is a standard example. We can say there was no maturity date for that perpetual bond also. That is an example given. Okay, calling by holder can also be done in this. Yes, here there is no redemption, but generally companies issue with the option for calling. Okay, so we will talk about that. Now moving ahead, we also have senior and junior bonds. Okay, whenever let's say there is a line, okay, in that line if senior is also standing, junior is also standing, who will get the benefit first? Okay, let's say you are getting some benefit by standing. Obviously the seniors will be getting the benefit first. You can remember in that manner. Here the benefit is the of the repayment. Okay, when repayment, let's say there is some company, now it's bankrupt, it is being liquidated, so at that time whoever is holding this senior bond, they will be given the repayment first. Okay, so there is a priority. So what happens when a company is bankrupt? It is unable to pay back the money in general. What can we talk about priority in paying? Okay, so it is unable to pay back. So that is why there are so many people, so many entities that the company has to pay back. Two entities who can be differentiated are people who have bought bonds and the people who have bought shares. Okay, these are the two basic entities between whom we can differentiate first of all. So bonds are those to whom there is an obligation to pay back, isn't it? Do you remember? Right? But shares, there is no obligation. That is why the priority of the people who have bought the bonds is actually higher. As a company, you can see it's on fire. So if it is actually bankrupt, in that case people who have bought the bonds will be getting the payment first. Now in the bonds also there are basically two kinds. There are many kinds, but basically classifying them into two kinds: senior and junior bonds. Okay, so the senior are those who will be getting the payment first, and then the junior bondholders will get the payment, and then the shares, whoever is holding the shares, they will be getting the payment. In shares also there are two kinds. We will see what are those when we discuss the equity market. Stay tuned for that. But yeah, there is some preference, okay, difference between them. Yes, equity and preference shares. So yeah, so in this way things happen. So in bonds, whoever is holding the senior bond is going to get first priority in the repayment. Is that clear? Right? Is there any doubt? Sir, can the bonds be both senior and junior, bond and corporate at the same time? Of course, it cannot be both senior and junior. It has to be senior or junior, and corporate, of course, it can be. Right, now you can start clubbing all of these types of bonds. Of course, wonderfully Nikki is asking whether it can be senior and junior and corporate at the same time. It can be senior and corporate, junior and corporate, like that. Okay, is that clear, Nikki and others? Is it clear? Yeah, senior plus corporate. Yes, definitely. Junior, after senior, they will be getting the payment. So it is high risk, and also the interest rates that these people are actually getting, the juniors are getting, that will be high. Okay, because their payment is delayed. So that is why the interest rate, they have to be given more incentive to actually invest in these junior bonds. So junior bonds are like junk, we can say junk bonds. You can relate it with that. Junk bonds are those which are issued by companies which are not doing well, and the interest rate is very high on them. Similarly, junior bonds also entail interest rate very high. Okay, the risk is also very high, similar to junk bonds. Okay, so there is one difference. I hope you can differentiate between them. Now fixed and floating rate bonds, who will tell me what is the difference between them? It is up to you. I already explained this thing. It is very easy in this case. Can you tell me fixed rate? If I say a 10% interest. Is it fixed rate? Or and then we have B, repo rate plus 4% interest. Which of these is fixed, which of these is floating? Can you just tell me? Fixed which one and floating which one? Can you just tell me very quickly? Okay, yeah, please tell me. Yes, A is a fixed rate because 10% interest is something that is fixed, while the second case, it is always, the interest rate is always entailed to some or the other benchmark. Okay, what is this called? This is called a benchmark, right? Benchmark in the sense this is some interest rate which is very much prevalent in the economy. Okay, in Indian economy, repo rate is something which is very much prevalent. We will talk about that when we discuss RBI and also in your ESI. But yeah, repo rate is a benchmark. Are there any other benchmark? Does anyone know about them? Okay, so we spoke about government securities. Okay, government securities are issued generally for 3 months, 6 months, right? So their government securities, how much amount of yield do they give? That is the return that they give, right? That is also a benchmark. This is calculated in percentage terms. We will also calculate in a few moments, right? So that yield is also a benchmark. Sometimes we say sometimes we say treasury bill yield rate of yield plus 5%. Okay, so let's say the rate of return is around 10%. So what is the total interest that you are getting on this bond is 15%. Okay, so that's too high. I would also want to invest in this, but anyway, so this is how this fixed and floating rate bonds actually work. Okay, Sensex, Nifty, I don't think, but yeah, these are some of the standards, these are some of the benchmarks. Is that clear? Right, so that is the fixed and floating interest rate. So fixed interest rates are also called straight bonds, in the sense they do not have any other features which might confuse you, so they are very straight. Plain vanilla. Okay, when you see the ice cream, the basic flavor is vanilla. Many might be liking the basic flavors also, they want to have a basic life. So anyway, so yeah, most of us like something very funky, right? We want some black currant or strawberry, so those things are added features. But here we have vanilla, which is actually having basic features of a bond. That is fixed interest rate bond. Floating interest rate bond, they vary as per a benchmark, say repo rate. Okay, and they are very market sensitive. You need to be very clear with that they are very market sensitive. They are as if you have invested in some shares. You will have to keep checking what is the variation in the benchmark continuously, so that you are not losing track of returns that you can get from your bonds. Okay, so they are very market sensitive. They are very responsive to the changes in the interest rate. Let us say repo rate, of course, is slightly fixed. Do you know what is the frequency by which repo rate keeps changing? Okay, you are going to write the RBI exam, you should know a little about it. Do you know what is the frequency with which repo rate keeps changing? Okay, when does the monetary policy committee meetings happen? Some of you might be knowing. So generally in India, the mandate is that it should happen every 3 months, but every 2 months this meetings happen, and every 2 months the repo rate keeps changing. Okay, and of course it is a very big event, the monetary policy committee meeting and all. Yeah, but it keeps changing, right? So in that way, if we go for a government security 3-month yield, right, so that keeps changing periodically, again and again it keeps changing. So that is why we can say that these are floating interest rate bonds are very much market sensitive. Okay, do you understand the term? Now moving ahead, yeah, here we can say the interest rate that is given on this particular floating interest rate bond is benchmark plus spread. Remember this, repo plus 6%, let's say. Sorry, so that is the interest rate given on the bonds. Now moving ahead, there are also inverse floaters. The formula is slightly different. This is also variable coupon rate, but the variation happens in the direction opposite to the benchmark. Okay, it can be something like this, 6% minus repo rate, something like that. Okay, so let's say the repo rate is 4%, right? So in that case you are only getting 2% interest rate. So that is how inverse floaters work. If the repo rate increases, what will happen? If the repo rate now becomes 5%, your profit is only 1%. Okay, so in that case it moves in the opposite direction, right? So repo rate increases, your interest rate decreases. Here what happens? If the repo rate increases, the interest rate also increases. Okay, initially if you take 4%, 4 plus 6 is 10%, that was the interest you are getting on the floating bonds. But if it is 5%, 5 plus 6 is 11%, so interest rate also increases. So there is a direct relation as far as the floating rate bonds are concerned. Inverse floaters, the name itself says there is an inverse relation. Okay, the floating rate is inverse. inversely related to the benchmark. Now moving ahead, we have the junk bonds. Okay, these are those bonds issued by financially struggling banks, or you can say companies. Okay, these actually issue them. So generally people who want to take a whole lot of risk, okay, who buys, many people buy, they do definitely want to get some people do buy, right, these rates, because they expect that there will be a fall in the standard rates, right? They expect there will be a fall and they will gain more in that way. So anyway, I just gave you an example, but they can gain from inverse floaters also. So there are different investment strategies. Obviously there is a person who might be liking many things. Somebody might be also eating Maggi with chapati, right? So we don't know about people, they like everything. So in that case we have to provide all the kinds of options, isn't it? So that is one option. Now here if we say financially struggling companies, banks, they issue this particular junk bond. These junk bonds have high, they have high risk entailed and high yield also. Okay, in the sense you they, in that you will definitely see the yield rates might be like 10%, 15%, 20%, right? So in that sense we can say these are giving high yield because the risk is very high. I hope the basic thing is very clear. We discussed this yesterday. So there are people who are risk averse, like I am a person who is risk averse. I don't want to take, I may not want to take much risk, so I will not invest in junk bonds. People who want to invest in the junk bonds are those who want high returns, okay, and they are ready to take the risk. चलो देखते हैं, ठीक है, पैसा ज़्यादा होता है तो कर लेते हैं. तो yeah, high risk, high returns is something that the junk bonds entail, okay. Is that clear? Yes. Is that 6% fixed, or we just take it as an example, not fixed, okay. It is just an example. Now moving ahead, we have callable and puttable bonds, okay. Callable and puttable bonds, right? Yeah, फिर हेरा फेरी, that those junk bonds. Okay, I should have put that image here. I will use this in my PPT next time. Thank you so much, Mahesh. So here we have callable and puttable bonds, right? So before moving into the definition, I would just like to show this to you visually. Here we have the issuer and the investor, or the bond holder, right? So these callable bonds, the bonds which are generally are those bonds. Let us say we have a bond, 10 years is the tenure, okay. Now if this bond is the bond is taken back by the company itself, let's say Reliance issued it, Reliance says, okay, I want to take back this particular bond, okay, I don't want to give the interest payments anymore, I want to take back this particular bond and do not want to pay the interest. So in that case this will be called a callable bond, okay. It gives the option to the issuer, right? On the other hand, let us say it is me, like let's say myself, Surinder, I have bought this particular bond and I say, okay, I don't want, your bonds are very bad, okay, they are not giving any profit, I don't want to have my investment in this particular bond, so I am returning it to you, okay, I want to return it to you, please close this particular bond. So in that case what it is called? It is called the puttable bond. What is that? When the bond holder closes that particular bond, okay, redeems that particular bond, it is called redemption, actually redeems that particular bond, while just even before the tenure is over, the bond will anyhow be redeemed at the end of 10 years, the maturity period. But before that, let's say in 5 years Reliance says this, or let's say in 3 years I say that take back your bond, that is called callable and puttable bond, okay. Callable, C gives the particular this is something that is very much favorable to the issuer, and puttable is very much favorable to the bond holder, okay. So you can remember like that. So in this case we can just add a love symbol for callable bonds are loved by the issuers, while the puttable bonds are loved by the investors or bondholders. So callable in the sense it gives an option to the issuer to redeem. I hope the terms are very clear. Issuer has the option to redeem that particular bond, close the bond and move ahead with not paying the interest, okay. That is the thing. Yeah, I hope things are clear. Yeah, but an option. Yes, not an obligation but an option. Interest rate in the callable bond, interest rate would be lower than the coupon rate, okay. So here what is happening, whenever the company is taking this bond back, it has to give some payment, right? That is called some premium, okay. So here there is a here there is some premium that the company has to pay, like Reliance has to pay something. Let's say from Neil it is taking away that particular bond. It is like I have called the bond back, so it is taking away, it has to pay a little to that to nil. Okay, so that he is satisfied. That is something which is paid. So by paying a particular amount of premium, this particular bond is given, right? Now the question arises, why should a company, reputed company, do this thing? Okay, right? Why should a reputed company do this thing? See, I'll ask you questions and if you are unable to answer, then I will catch you. Is that okay? Right? Yeah. Why should a reputed company do this thing? A reputed company will do this thing because, let us say, a company has issued a bond at 10%. Okay, imagine yourself to be the owner of the company. Now in the market, if you see, there are various instruments that have come out that are giving an interest rate of, let's say, 8% only. Now this company is still giving 10%. Okay, so it will say, okay, I have an option to call it back. When the interest rates in the market reduce, then the company is going to get this bonds back. Okay, it will say, okay, I don't want this bonds, I don't want to give 10% interest, the market interest rate is 8%, I will call back my bonds. Okay, it will call the bonds back by paying a certain premium, short premium. 100 रुपए ले लो, मुझे bond वापस दे दो. Like that, it will pay a small amount of premium, and then it will reissue at 8%. See how smart. Okay, why is this done? So that whenever the interest rates in the market are lower than whatever the bond is providing, then it is issued back. Okay, it is redeemed back. That is called a callable bond. And here it is reissued. Okay, so to satisfy Neil, let's say, who has bought the bond, small amount 100 रुपए दे दिया जाते हैं, that is called premium, and then it is reissued at 8%. Okay, is that clear? So that it is not paying lower than the market. So this option is there with the particular issuer, so that is called the callable bond. Now puttable bond option to the bond holders to sell to the issuer back. Okay, they will sell this particular bond back to the issuer, right? When can that happen? Can anyone tell me what is the situation of the interest rates in the market? Can you just tell me in the chat box very quickly? Now let's say 10% bond has been issued to Ashwini. Okay, and in that case he is saying, okay, take this bond back. Why is he saying? Yes, in the market the interest rates are higher. Okay, of course you could sell it to someone else, but you are unable to sell it. In that case, what you will do? You will use your puttable option and then you will give it back to the company. Let's say in the market 15% bonds are there. Okay, I will withdraw my money from here and invest in the 15% bond. No? Market interest rates are higher. In that case, puttable bonds actually come into action and the bond is given back to the company itself. Is that clear? Now moving to convertible and non-convertible bonds. Okay, redeem the bond and purchase the higher interest rate bonds. Absolutely correct. Okay, everybody, all of your answers are right. So convertible, non-convertible bonds. Now we spoke about two things. One was debt and the other was equity, right? So generally bonds, certain bonds have this feature entailed in them that they can be converted into equity or they can be converted into shares. Okay, so that is called the convertible bond. Okay, the company itself has this particular feature, right? Company has this option and it says previously, okay, this is a convertible bond, if you want to buy, you buy, we will convert it into equity, or it gives the option to the bond holder that at maturity you can choose either of the things. See what are the benefits to the company by doing this thing. Okay, yes, Pradeep, finally somebody is answering on YouTube. So people, I would like to request everyone on YouTube also to please participate and please keep answering the questions, right, whatever you're seeing over here. So what are the benefits that the company is going to get, right? One thing is bond entails an obligation while shares do not have any obligation. That is one benefit. Okay, the obligation is converted into just dividend payment. Okay, and you are giving some part of the ownership. The second thing is on maturity, as the bond has matured. See, the bond has matured. Now, अरे 1000 रुपए देने पड़ेंगे. Okay, the company has to return that money. In that case, it says, see, there is an option. Either you take the money or convert this bond into equity, like that. So it will convert into equity, right? So in that case, what is there? It does not have to pay back in cash. Are you getting the point? There are two benefits of a convertible bond. Do you get it? These are very much linked. When we discuss further ahead equity and debt chapters, there also we'll see all of this. But why would company again issue bond if in past they are giving 8% and now they will have to pay 15%? Okay. Market rates change. We cannot do anything. Okay. RBI says the syllabus is changed. Surprise, what will you do? You have to read the new syllabus only, no? In the same way, the interest rates keep changing. So in that way, as the market interest rates change, Priyanshu, we have to adopt to that. That is the thing. Is that clear, Priyanshu? Then, sir, when the bonds are converted, then is there any discretion of the holder if he wants to preference or just normal? See, that is deeper thing, but for now there are these options. Okay, that is what I'm telling you. On maturity, there are different options given by the issuers themselves. Okay, based upon that will be conveyed to the particular bond holder, and then they will buy. So it can be that the bond holder might say no, we don't want to do this, and they won't do it. Either of them, it can be that. But yeah, I'm telling you that this option is definitely given. So here what is happening, the obligation is converted to just dividend payment. Other than that, at the end, no need to pay in cash, only equity payment can be the conversion into equity can be done. So cash is also saved. Non-convertible bond, you cannot convert to equity. So convertible bonds, generally the interest rate is low. Okay, and this the interest rate will be low, because after there is an option provided along with that particular bond, there is an option also given that later on you can convert it into equity, you can gain from it. Okay, you can continue your gains from that particular investment. So option is there, so the interest rate is low. Non-convertible, अरे ये सब झंझट में कौन पड़ेगा? We want non-convertible bond. We want fixed payment. So the interest rate in non-convertible bonds is high. Please remember this thing. Is it understood? Is the reason understood? ठीक है? Converted to equity, yes. Is the reason understood? Why non-convertible bonds? There is no option, right? So interest rate is high on them, but in convertible there is an option. You also get the option of getting converted into equity. You get that option. So that is where the interest rate is low, right? So in that case, this is what bond getting converted into equity, that is convertible and non-convertible bond. Now moving ahead, there are other kinds of bonds. Okay, quickly let us discuss them. Here we also have the serial and term bonds. I'll show this to you with an example. Here you can see, let's say there is a bond of 10 years. One is serial and the other is term bond. So it is around, I don't know, so many dollars. So this entire payment is promised as far as this bond is concerned at the end. Okay, definitely I would also like to buy this bond. But yeah, here all the payment is done on maturity. At the end of the 10th year, all of the payment, whatever par value payment was promised, okay, so many zeros, dollars, this one is something that is promised at the end. The payment is done at the end, right? That is called one shot payment at the end. That is the traditional or a term bond. But serial bond is that wherein you get that payment split into different parts. Okay, there are multiple maturities in serial bond. Okay, many maturities, and for the issuer it is very easy, right? At the end it has to just give this payment in small parts. So for the issuer it is easy. So which one is easy for the issuer in comparison? When we compare serial and term bonds, serial bonds are something which are very much easy for the particular issuer, right? So term bond is where one time payment is to be done. For us also, if we have to pay installment, that is how we buy a whole lot of things, right? Car, buildings and everything, right? We buy home, all of that. So one shot payment would be difficult for us. If there was no EMI thing, it would be difficult for a whole lot of people, isn't it? Yeah, so that is the thing. Serial and term bonds, that is the difference. I hope that is very clear, very simple short difference. Now moving ahead, we have this green bonds. We already discussed, if the bonds are issued so as to fund eco-friendly projects, then they are called green bonds. Now here they are also called climate bonds. Okay, please remember the other name, very easy, climate bonds. Can anyone tell me in 4 letters what is the other name for revenue bonds? Anyone tell me in 4 letters? Revenue bonds. Okay, other name for it, or the initial name for it. Okay, that is muni bond or municipal bond, isn't it? Remember, so please remember the other names. Console is for what? Please tell me very quickly. Dash bonds. Console, yes. Perpetual bond. Okay, that they are also sometimes called, yes, prep. Okay, prep. So here we have the climate bonds, right? And whoever invests in the green bonds, they get some tax benefits. Obviously there should be some incentive that people invest in these eco-friendly things also, otherwise people are only bothered about profits. So sorry. So these are the things. Now there are different kinds of green bonds issued by RBI and SEBI. So here RBI has Yeah, definitely I will tell you. Here RBI has issued this sovereign green bond, right? Sovereign in the sense, I hope you understand. Green also you have understood. Okay. On the behalf of the government of India, this sovereign bond is issued. And green bond is something wherein the money is utilized in eco-friendly projects. Examples of eligible projects or for this are renewable energy, energy efficiency, green infrastructure. All of these are developed in that way. Okay. Yeah, I'll definitely check this. Then here if we have SEBI also has issued different kinds of green bonds. The green bond is one is called green bond, the other is blue bond, and the other is yellow bond. Okay, Omkar, I will check this, right? So here if we talk about the green bond, these green bonds are actually in the money from that is actually invested into the eco-friendly projects, vegetation, wildlife. Blue bonds with respect to this, let's say we have a project of cleaning the river or developing a purification plant. Okay, so all of these things come under the blue bond. Blue bond money will be going there. Apart from that, we have these yellow bonds which actually help in financing projects like solar power plant establishment. Okay, solar energy these panels are actually established from the money that comes as part of the yellow bond. Is that clear? What is the difference between term bond and zero coupon bond? Zero coupon bond, there is no interest payment. Okay, at the end one single zero coupon. See, I'll just show you in one shot. 1000 you have bought it at 900, so this is zero coupon. Term bond may be this. General bonds are generally term bond. Okay, that's the difference. There might be also the interest payment, right? I'm just talking about this par value maturity amount being given in at once or multiple maturities. Okay, so that is what I'm talking about. Piyush, is it okay? And Omkar, I'll definitely check. Other bonds also give the yeah, they do give. Green bonds much more tax benefits, more incentives. Can any corporate office related to sustainable energy issue these bonds? Yes. Yes, definitely green bonds can be issued by others also. You have eco-friendly project, your work is totally towards developing eco-friendly projects and all, you can definitely issue this. But I'm talking about some of the bonds which have been issued by our regulators, right? So these standard bonds, so I'm talking about them. So these are the things. Sovereign green bonds, and SEBI has issued these three kinds of bonds, green, blue and yellow bonds. I hope you'll be able to remember. That is why I'm showing you the image. Now moving towards the end of this topic, here we have registered and bearer bonds. Okay, so you can see this bond over here. The name is written John Smith, some amount is written and some corporation has given. So like in a check, what do? You give all the details very clearly, signature is given very clearly, all of those things are given. That is called a registered bond, right? It is not like a bond to whomsoever it may concern. Generally bonds are given out in that manner, but registered bond is that wherein you have the name printed, the amount and everything. There are other features also, we'll discuss. Now bearer bond is whoever has the bearing, or whoever bears this particular bond, whoever has the possession of this bond, they will get the benefit. Okay, for example, this bond, the benefit of this bond can be given to John only, John Smith, nobody else. Okay, but let's say John has bought this bearer bond. Normal bonds are generally bearer bonds. Okay, John has given this bond to some Sally, and that Sally will actually get the benefit later on. It can also be some people may also, like there might be thieves also, right? This bond can be taken by them, so that theft is something that is prevented as far as a registered bond is concerned. But generally nowadays whoever holds the bond, they are going to get the benefit, because bonds are tradable. These what can we say about registered bond? They are not tradable. Do you get it? Do you understand why? Right, I hope you are able to relate with this. These are not tradable, because you cannot give it to someone else and they getting the benefit cannot happen, because it is registered on your name only. Is that clear? Now bearer bonds are tradable. Is it clear? Can you just relate with me? Now interest payments are also done over them. Both of them interest payments are done. You see, the registered bonds are really sophisticated. The interest payment comes to the particular person's home. It is delivered to the home in the form of check, and they withdraw the money. All of those things might happen in a very systematic manner in the bearer bonds, because the name is given, the money is sent to the home. While this the registered bond, yeah, bearer bond, what happens? Whoever holds this particular bond, they will be getting, like let's say there is some goon who is holding this particular bond, they will get the benefit of it in that way. away. So it is paid to the holder. Tracing, once it is lost and all, tracing that is very difficult. Okay, in short, registered company keeps the record of the holder. Yes, very good. It keeps the record of the holder, and that is not changeable, and they give the money to them directly. It is like that. Okay, that is the registered and bearer bond. From the images also, I hope it is very clear. You can very clearly understand this. Now moving ahead to certain other kinds of bond. There are some miscellaneous bonds or other types of bonds. Not many questions have been asked, but yeah, we should know about them so that if any question is asked, we are able to answer them. Now elephant bonds. Elephant is huge amount bond. Okay, remember like that. Elephant bond is used for development of the infrastructure. Although the relation is slightly less, but elephant is huge. The amount that these bonds are used to raise the capital, that is also huge amount is raised with the help of elephant bonds. Why? Because they are directed towards the infrastructure projects. You can remember from this image, elephant on the bridge, right? Benefits are improves transportation, communication, energy system, creates jobs, economic growth, all of these things. Yes, of course, national highways also. Now moving ahead, there are other bonds which are called social bonds. Obviously the name itself says social bonds are like which provide some welfare, which are issued towards some welfare activities. Okay, some social benefit is provided. Positive social outcomes are financed with the help of the social bond. Okay, and these social bonds have to be aligned with the International Capital Market Association social bond principles. Okay, these are certain principles given by this organization, which is an international organization called the International Capital Market Association, ICMA. There are certain principles to issue these social bonds. Okay, those principles have to be definitely adhered to while issuing the social bonds. Okay, these are the benefit of these social bonds are towards underprivileged and underserved communities. Okay, like there are certain communities might not have the health facilities, proper education facilities are not there, so we issue the bond. Let's say a particular the municipal government issues this bond, and then it is building a hospital, it is building this education center, so it is directed towards them. Since it creates impact in the society, it is also sometimes called social impact bond, SIB. Okay, so we will talk about these very carefully ahead in the debt market also. For now I have just given you an idea on them. Is it clear? Social bond, also sometimes called social impact bond. Okay, yeah, any organization can issue, any company can issue, NGOs can issue. Okay, foreign bonds is the next topic here. Foreign bonds are issued by foreign company for Indian investor. Okay, foreign bonds, they are issued in foreign country, remember like that. So foreign bonds are those bonds which are issued for Indian investors but outside India. Okay, might be directed to other investors also for open for the Indian investors. So these are foreign bonds. Yes, very good question. Piyush is saying how do they generate any revenue, right? Previously I said hospital charges, all of these things, they charge a whole lot, we know that. But yeah, these, if they are public facilities, the charges will be less, and these facilities are actually taxed by the government. Okay, we give taxes, the tax goes to the government spends, okay, in that manner, and it is also taking money from the public and doing these activities. Government might not presently have the money, so it is taking money from the public by issuing the bonds, and it will return from its own revenue. Okay, government will return it from its own revenue, right? That foreign bonds, if they are issued in foreign countries, they will be of foreign currency, right? Foreign currency, mostly US dollars, right? Let's say here Tom Cruise is issuing the bonds of his own company, right? We are buying, investors or bond holders are buying in India, so that would be mostly in the foreign currency, and it is directed towards all the investors and also the Indian investors, so we can buy them. Okay, so if you are really interested to buy Tom Cruise company's bonds, you can definitely change the rupees to dollars. Okay, so I hope things are very clear till here. Yes, Nitin, welcome to the session. Elephant bonds issued, yeah, might be issued by companies. Very good question. Pradeep is asking over YouTube that elephant bonds are issued by whom. They might be issued by the companies or by the government. Okay, I hope we all are ready for the rapid fire round over here, right? So this is the part from where RBI phase 2 many questions have come. So I'll show you the previous year questions also as part of this rapid fire round. I hope we all are ready for this. Okay, off the cliff end. Okay, first question for you, please answer it. Over YouTube you can also answer, Pradeep, your doubt. I hope your doubt is clear. So what is the first question here? Various kinds of bonds. Identify the bond which does not give any coupon payments. It's so simple. Okay, so I think Siddharth has answered first. Okay, sorry, somehow I think I have not included you in the list. Yeah, Siddharth, Pragya, Pragati. Right, there is no coupon payment. Which kind of bond it could be? I didn't talk about any no coupon bond. Did I talk about no coupon bond? Issued to general public. All of these bonds are issued to general public, Pradeep. Okay. Yes. So the correct answer here is C, absolutely. And we spoke about zero coupon bonds. Some of you have answered A. So the correct answer is actually C. Siddharth gets the point. Moving to the next one. So these are actual questions asked in RBI. Please answer them carefully. Okay, so true about zero coupon bonds. Here they have asked. They have fixed payments at regular intervals, obviously not. They have variable payments, no. Fixed payment at regular interval, no. Variable payment at regular. This is not the thing, right? So the correct thing is they have no payments till maturity, but one final payment at maturity. So E would be the right answer, and Pragati gets the point over here. Wonderful, Pragati. Is that clear? I think I don't need to answer this, explain this any further, right? Question is not visible. Why so? I can see on YouTube the entire question. Okay, please check it. Please rejoin the session and check it once. Here is the third question, please. I have simultaneously opened YouTube, Pradeep. Previous one. Okay, I'll show you the previous question again. Please answer this third question. So console bond, following statement is true about the consoles. Console bond is a form of a British government bond that has large maturity and that pays a fixed coupon. That has lesser maturity, it has no maturity and that pays a fixed coupon. Large, lesser maturity, the same thing. Okay. So console bond is actually that bond which is also called what? Perpetual bond. Okay, perpetual bond, right? So yeah, I think here C is right, and I think Ria gets the point here. Piyush, did you answer first, or were you answering for the previous question? Tricks to read fast. You asked the supercomputers. This one, then Piyush gets the point. Okay, very good. So C is the right answer. Okay, supercomputers, please tell them how to read fast. Here is the next one. I think I am able to understand what the trick is. Ashwini has also answered first. Okay, there are various types of bonds which are issued. Yeah, identify the type of bond which matures multiple times. Okay, the maturity is multiple maturity. Which kind of bond are we talking about? Okay, yes, very good. A is the right answer. Here I think I will have to give point to Ashwini. Seeing just the options. Keywords, read the last line. Okay, anyway, so you can pick from here. So here we have option A, serial bond. What is the other one, right? The bond in which the payment is done at the maturity, at the end. What is that? Yeah, term bond, right? That is a traditional bond. Yes, very good, Pradeep, your answers are also absolutely right. Let me give you also 2 points. Now moving ahead, here is the Next topic. Okay, so here we have seen the different types of bonds. Now naturally a question arises in the mind of people who invest in the bond, is that now there are so many types of bonds, how shall I decide which one of them gives the maximum return? Because Rita is always bothered about return. She is just saying in which shall I return, how shall I just calculate the returns. Okay, those people are me. Yes, so me too. So here we have Professor Vinay answering. Good question. Let us see. Now we will be talking about the technicalities of the bonds. Okay, so let us have a look at the technicalities of the bond. And before moving ahead, let me just ask you, I will just give you one scenario and you just have to answer a few questions to me, and then the part of discussion of the technicalities will be not that much technical and complex. It will be easier for us. Here one question that I want to ask you, here is a bond that I want to show 1000 rupees and you can buy it at 900 and it is paying 10% interest. Let us say the maturity time period is 1 year and the coupon payment is done every 6 months. Okay, so can you tell me what is the total benefit or profit that you are getting by buying this particular bond? Okay. Yeah, he loved finance and we changed his name later on. Okay, so please tell me what is the total benefit or the profit that you are going to get out of this bond. Did you understand the question? 1000 is the par value, 900 you have bought this particular bond, 10% interest every 6 months this interest is being given. That entire tenure is 1 year. If you hold this bond till the end, okay, till maturity, how much is the profit that you are going to get? Okay, so if I write the profit over here, I'll write over here profit. It consists of various components, isn't it? There are two main components of profit that are there over here. What are those two? Yes, I think 300 is the right answer. Firstly, you bought it at 900. If you hold it till maturity, you will get 1000 at the end. So the first component of the profit that you are going to get is the difference between what? Difference between the par value and what? And the current market price, isn't it? Can I say that? Can I say this is the first part, profit portion that I'm going to get, and the other profit portion that I'm going to get is the coupon payments, isn't it? Coupon payments over here, interest payment, isn't it? So par value is 1000. Let me calculate, minus 900, and the profit that I'm going to get over here is 100. Okay, while the coupon payments after 6 months, after first 6 months, 10% of 1000 is given to me. 10% of 1000. Now here come calculations. You have to be quick in calculation. So 10% of 1000 is 100. I hope you know. So 100. And after another 6 months, I have received 100 more rupees. So coupon payments in total I have received at 200. While the profit that I have received over here, the difference between how much did I buy and what is the par value, final value, is this 100, isn't it? So in that case, the total profit that I'm going to get over here is nothing but 300. Can I say that? Right? So of course we see that, okay, coupon payments are coming. There's another thing also, profit that we can see. So the entire thing, the entire profit that we are getting, instead of profit, I call this thing as yield. What do I call it? I give it a new name, which is yield. Okay, do you agree with this? The entire profit that is coming out of this, of course this is not a perfect calculation. I'm just giving you an idea. Okay, don't stick with it. I'm just giving you an idea that there are various benefits that you're going to get, profit in different ways. So that entire thing is called yield. Let's move ahead and try to understand them. Okay, now what is the need to understand these technicalities? Coupon rates, maturity dates, credit ratings actually shape the performance and risk of the bond. When you want to invest in the bonds anyhow, you should be knowing which bond I should be investing. Let's say you have the same kind of bonds, everything, but you need to know which one of them actually will be giving you most benefit with least risk. That is what generally we want to do. Okay, so in that case we will have to check that, and for that we are going ahead and trying to have a look at various of these things. Yeah, actually I'm so sorry, today we may not have a break, but from Monday we will have the break. Okay, because this is live streamed over YouTube, right? So what we'll do is we'll go continuously, and yeah, if you are unable to understand anything in between, you can please tell me. Kashish, is that okay? Right, just for today Monday we'll have. And yeah, moving ahead, we are talking about the technicalities of the bonds. Okay, the first thing that I said is yield. Now this yield is of different kinds, many kinds. Don't worry Kashish, you can just do other things if you want in between, but yeah, I'm explaining in such a manner that it will be very clear to you and ज़्यादा burden नहीं होगा दिमाग पे. ठीक है, तो yield is current yield, right? There are different kinds of yield: current yield, yield to maturity, yield to call, various things we will see. But for now, I hope the concept of yield is understood to you, that different benefits together they are clubbed, and then that thing is called yield. Now firstly we will be talking about a term called current yield. Okay, we will see how to calculate it, everything. For now this is current yield. So overall return an investor expects each year. Okay, every year what is the return that you are going to get, that is the current yield that we are talking about. Okay, now formula for this is yield can be calculated by coupon amount divided by current market price of the bond into 100. Okay, so what is this formula? Taking the same example again, 1900 you have made the payment, this is the current market price, let's say. Okay, and let's say 10%. This time let me take this bond to be of 2-year bond. This year what is the return that I'm going to get? In this year, in the first year itself, what is the total return that I'm going to get? Can anyone tell me? What is in the at the end of first year, what is the return that I'm going to get? What is the return that I'm going to get at the end of second year? Total money that I will get from this bond at the end of second year, that also you can tell me. At the end of first year, I will only get 10% of this particular par value, isn't it? 10% of 1000 is something that I'm going to get, right? At the end of the first year, what is that? 100 rupees only. While at the end of 2 years, how much am I going to get? I mean at the end of second year, not 2 years, at the end of second year, how much am I going to get? I will get again 10% of 1000, isn't it? 10% of 1000. I'm searching for the right answer, not 200, not 100. Let's see who will give the right answer. No, I'm just asking the return. Okay, how much will I get after at the end of second year, not 2 years together. I'm just asking at the end of second year, how much will I get? Okay, that is what I'm asking. So yeah, Ria's answer is right. So I will get 10% of 1000, which is 100 rupees, and also the maturity amount, isn't it? The maturity amount is also something that I will get. So in total I will get 1100. Can I say this? Okay, can I say that I will get in total this much? And of course I'm the profit that I'm getting is I paid 900 and 100 rupees is the profit. That is a different thing. I'm just asking what will be the cash flow. Okay, I hope you know a little about this term, cash flow. What is the cash flow at the end of the second year from this particular bond? At the end of first year it is only 100, at the end of second year it is 1000 plus this 100 interest rate. So I'm getting 1100 as the cash flow. Okay, so let's ignore for now this one. We are talking about the current yield. Okay, so current yield generally indicates whatever is the coupon payment that you are going to get, because at the end of first year I am only, current means in this particular time period, what is the profit that I am going to get. Okay, and we generally calculate a profit percentage. Okay, yield is generally a profit percentage. How to calculate profit percentage? Profit percentage is nothing but profit, I hope you know the formula, divided by what? The payment that you have done. Okay, whatever payment you have done into 100%, isn't it? खर्चा जो हमने किया, that will come at the bottom. Okay, whatever payment you have done, that will come in the bottom, and in the denominator, and in the numerator you have the profit. So here current yield is something wherein only the coupon payment is considered. Okay, by payment that you have done, current market price 900 into 100%. Okay, do you understand? So if we solve this thing, we'll be getting the current yield. You can tell me how much it is. Now this 100 is what? This is the coupon payment. This 900 is what? Current market price into 100% is nothing but the formula for the current yield. Do you get the background of it? Do you understand? Will you be able to calculate current yield if they have asked in the exam? Okay, so that is yield, coupon amount divided by current market price into 100. Okay, so that is how you will be doing. That is the formula for the current yield. Just presently we have to calculate. This is around, yeah, around 11% or something, right? So that is the thing. Now this current yield, it is generally when we say change, what is the change in this particular yield, right? So whenever the current market price increases, right, let us say because the coupon payment is fixed, it is 10% of the par value. These two values are fixed. What should the current yield depend upon? It is dependent upon the current market price only. Let us say for now the price of this particular bond is 950. Now if I want to calculate the current yield again, okay, if I want to calculate the current yield again, then how will I do? 100 by 950 into 100%. Okay, now this value, what is this value? Can you just quickly tell me? 100 is the coupon payment, isn't it? So 950 is the price, the market price has changed. So what will happen to this particular current yield? Please tell me the answer for this, how much it is. Yeah, it is around 10.5%, isn't it? So previously we got around 11%, now we have around 10.525%, right? So as the current market price increases, means what payment you have done is increasing, the current yield is going to decrease. They are inversely proportional, obviously, because this is in the denominator and the other one is in the numerator. Is that clear? So that is the thing. So only thing, if we say what determines this current yield, only thing which can vary the current yield, in the formula we have this coupon payment which is fixed. Okay, coupon payment might be variable, we could think, but coupon payment, considering most of the bonds, it is fixed. The only thing on which this current yield depends is the current market price. Okay, so it is determined as per the current market price, right? And this is a better gauge of performance of the particular bond. How does the bond perform, how much return it will give, we can understand by the help of the current yield. On the other hand, interest, which is also called the coupon payment, right? Coupon payment is a fixed or predetermined interest that you are getting. Okay, now comparing both of them, what can we say? Yield is nothing but the overall return, that is the coupon payment in comparison to the current market price. We calculate the profit that we are getting, and it is determined as per the current market price, yield, while interest rate is fixed, isn't it? Coupon payment is fixed, right? And formula, it is based upon the par value. It does not change, it remains fixed. It is based upon par value. Interest rate, if anybody asks you what is the difference between coupon payment and yield, coupon payment depends upon the par value, but current yield actually depends upon the current market price. There is a difference between both of those. Yes, very good. Relevance doesn't account for bonds market value. Okay, let's say the in the market the interest rate has changed. Will the coupon payment automatically change on the bond? No. Okay, it has to be called back, then it has to be reissued. All of those things had to be done. Okay. Good question, Priyanshu. Yield calculates on the CMP, interest is on the face value. Absolutely, Krishna. Is that clear? Are you able to understand the difference between both of these terms? Right? I hope it is clear. Face value, yes, that is there are standards actually. If you see the face value of there are standard values. The government securities 10,000 rupees is minimum, like that. Okay, based upon how much you want to, how much the can the people afford to pay on the bonds that you are issuing. Various things are there. Okay, based upon the market, the face value is decided. Okay, Priyanshu, now is the difference clear? Now this is for current yield, normal yield and interest that we are talking about. It is like if we talk about this person Neil, right? This current yield actually has a whole lot of linkage with the market. Okay, while the interest does not have much linkage with the market. It is like Neil who's going for an interview, very much dynamically investing, a person like that. You can just compare it, current yield, to such a person, while a person who is just as at home, okay, not doing much, and you can compare these two people in that manner. So this person has a whole lot of linkage in the market. So current yield has a whole lot of linkage with the market. Variations in the current market price actually affect the yield, while interest does not get affected with that. Okay, just silly comparison. but yeah, here we are moving ahead and discussing another term which is called yield to maturity. Okay, again let's discuss it again. Here we will talk about this particular bond, 1000 and 900, and here we have 10% interest, right? If we talk about what are the different payments that we are going to get out of this particular bond, again the cash flows that we are going to get out of this, profits that we are going to get out of it, we have already discussed. Let us say again it is of 2 years, then what are the total profits that we are going to get out of this particular bond? There are two parts that we have discussed. Okay, Yeah, after this topic we will think. Okay. Surely after this topic we'll take a break, right? Is that okay for everyone? We'll take a 5-minute break after this topic, right? Ashwini, Kashish, Ria, everyone, is it fine? Okay. Now please pay attention on this. Here we have this bond, 1000 is the par value, 900 is at which you have bought, 10% is the interest. What is the total payment that you get, total profit that you are getting out of it? Again, recalling, total profit we will be getting at the end of the first year, right? We are getting the coupon payment 100 rupees. I hope by now you know at the end of the second year we have 100 rupees coupon payment coming. Apart from that, we also have the difference between what we have paid and what we will get at the end of the maturity of this particular thing, which is nothing but 1000 minus the 900, so 100. Okay, so we will have to add all of this, but this is the total. 100 rupees is for the entire 2 years. Okay, after 2 years you are going to get this amount, but if we want yearly basis payment, so what we have to do? Okay, that is what this yield to maturity says, right? And then comparing it to the money that we have actually paid, that is also done in yield to maturity. Okay, once we will have a look at the formula and things will be much more clear. In yield to maturity, all of these payments, all of the profits that we have obtained from this bond, everything is incorporated. That is what I want to tell you. Okay, all the 300 is incorporated in a very proper manner. Okay, and that is brought down to yearly basis return that the bond might be giving. Okay, so we'll see how this formula incorporates all of these things. One thing is it has to incorporate all of these profits. Second thing is it has to be yearly basis. It has to give an idea of yearly basis income or profit that you are going to get. Okay, so how these both things are incorporated in yield to maturity formula, we will see. Now the term is clear to you. Is the term clear to you? Yield to maturity, right? Yield to maturity in the sense you buy the bond 2 years ago. After 2 years you are going to get the total profit of that bond, and between these 2 years what you have done, you have not traded the bond, you have held it with yourself. Okay, that is the thing in yield to maturity. If you have held it with yourself, what is the total profit you are going to get, right? That is the concept of yield to maturity. Yes, 900 plus 300, I would say that, but we will see the proper formula and try to discuss it. Is YTM the coupon payment received in first year invested again? Very good. Very good question, right? So yeah, generally in yield to maturity, this there are two assumptions that we will talk about, right? First of all, let us try to have a look at the yield to maturity. The concept is clear. If you hold the bond till the end, till the maturity, whatever is the return, that is calculated. Now here as I said, two things have to be incorporated: the entire profits and yearly basis calculation. So we will see that. So yield to maturity is actually annualized total return an investor expects if he holds that particular bond till maturity. Okay, so what are the different returns? The current market price is incorporated in the formula. We will see how. Also the coupon payments are incorporated in the formula, and the par value is also incorporated in that particular formula. Okay, in a very systematic manner. We will see how that happens. So what is the formula? Here we have Rita, but she is looking somewhere else, I think. So we have to tell her, पीछे तो देखो, she is still not looking back. So anyway, here is the formula. Okay, the major big formula has come here. Yield to maturity is nothing but annual interest. Okay, so in 1 year, what is the coupon payment that you are going to get? Because we need to have a look at the payment that is happening in 1 year. As far as our example, 1 year the coupon payment was 100, isn't it? Now look at the other part, par value minus market price. Is this justified? Okay, 1000 is what you will be getting at the end. Apart from that, market price, let's say you have paid 900. Okay, this 100 rupees was for 2 years entirely you were going to get. Now if you want to reduce this to 1 year, what you will have to do, 100 by 2 will give you the amount that you are going to get in 1 year. Can I say that? Do you agree with it? Right, all of you, do you agree with this? 100 by 2 nothing but 50 rupees is something that you can say yearly basis I am getting the profit. That is what is done over here. Par value 1000 minus market value 900 divided by number of years to maturity. Okay, this is actually the number of years left to maturity, right? That, let's say you have bought it at the beginning, 2 years are left to maturity, and that by 2 we will be doing. Now all of this is divided with something. Okay, what is this in the denominator? this is the profit. At the numerator we have the profit, denominator is whatever you have paid. Okay, generally whatever you are going to pay, then multiply it to 100%, of course that is there. So whatever you are going to pay, what happens with this particular bond is that the current market price keeps changing, right? The market price keeps changing, but mostly it does not go beyond the par value. Okay, mostly it does not go beyond the par value. Sometimes it goes where we say that yeah, it is sold at premium, but in this formula I said there are various assumptions. The values between par value and the current market price, like the value now it is you bought at 900, but if you want to sell to someone else, let's say you are able to sell at 950, that means the price has changed, and that price has changed between 1000 and 900. So we take an average. Okay, we do not take 900, we take an average. Let's say somebody else is paying, you have bought it at 900, somebody else is paying 950, someone is paying 925. So we just take an average of both of them, par value plus market price by 2. That is how you take an average, isn't it? So we take an average of amount that you have paid and then multiply it to 100% to get the yield to maturity. Is the formula understood? Please tell me very quickly, is the formula understood? Okay. YTM is the coupon payment received in first year, invested again. Yes, that is one thing. This is called the reinvestment assumption. The coupon payment is reinvested again and again. This is one assumption. Second, very straightforward assumption is that you may not hold the bond till maturity, right? That is another assumption. So yeah, I hope the formula is understood. Here is the coupon payment profit. Here is the difference between the par value and the market price that you are going to receive. Now at the bottom you have what you have paid. It is a sort of an average that we are discussing over here. Okay, so here everything has been incorporated. Is that clear? Yes, in the numerator, Madhav, we have the profits are what? Annual interest. Here in our example it was 100. Annually how much coupon was paid? 100. Then difference between par value and market price. Let us just draw this bond again. 1900 and 10% interest. So here this is the coupon, so 100 rupees, right? And the difference between both of these is 100, but this, the maturity for this, let's say, is 2 years. So for 1 year what will be the amount that we have done? 1000 minus 900 by 2. If you do that, 100 is for 2 years, so for 1 year by 2 you have to do, and 50 is the amount for 1 year, because we are calculating YTM for yearly basis. Okay, so par value minus market price by number of years to maturity. And in the denominator, because the current market price keeps changing, we take an average of the prices. Okay, Madhav, is it clear? Others, is it clear? Okay, sorry. Yeah, so that is the formula. I hope you will be able to remember this and you will be able to apply it. Okay, still see, she did not see piche. So anyway, there are two assumptions: that we are holding this bond till the end, till maturity. That does not happen. Okay, yield to maturity. I may not hold the bond till maturity. 2 years. Who will hold the bond? I will sell it to someone else if I get a better price. That is one assumption that we are making over here, that a person who has bought it might hold it till maturity. And reinvestment, that is whatever amount. So the here different things, the current market price may change, right? And different in different situations the bond various things might be changing. Of course the annual interest par value will not change, right? But the market price, current market price, might be changing, we can say that. So in that case, with so many variations, we cannot go for any fixed interest rates, fixed returns, right? But this gives an average value, this gives a estimated value. Okay, so there's another assumption that is taken, that all of this amount, whatever you are getting at the end of first year, that is reinvested, right? Till now we discussed about compound interest. So the same thing is happening over here also. In yield to maturity, the same compound interest sort of a formula has been given out, and it is expected that whatever has been obtained at the end of first year, that is reinvested. Generally we may not do that. Okay, what you get at the end of first year, let's say you get 100 rupees at the end of first year from the bond, the interest, you may not reinvest it in the particular bond itself. That may not happen, that option may not be there, but the formula actually assumes it is reinvested. Okay, we will further ahead also see, make this point much more clear, how we can say the reinvested thing is done. Okay, how we can say this assumption is made, right? But for now, just think that in this formula, the formula incorporates all of the terms in such a manner that the interest rate actually is whatever interest we are obtaining is reinvested is something that is assumed, right? So in that way this formula has been brought out. Sir, is if invested again, then we will get more coupon payment than first year. Yes, all of those things have been incorporated in this formula. Okay, and further also we will talk about another formula while discussing the bond price. Things will be much more clearer to you. For now, of course, this holding till maturity is an assumption. We may not do that, and the amount that we are having, getting interest that we are getting at the end of first year, that is reinvested, is something that is assumed. We may not do that. Okay, so these are the assumptions. Reinvestment assumption I will explain much more better while we are discussing the bond price. For now, just take this as my word that yeah, this assumption is taken while coming up with this formula. Now moving ahead, this is very much helpful in comparing the returns, okay, which is decided based upon the, and you go for the best investment. Okay, you compare the YTM and then you go for the best investment, right? Okay, is that clear? So you go for the best investment. YTM is such a thing wherein you can decide this. Now tell me, now please let me know, if at all current market price increases, what will happen to the YTM, yield to maturity? How will it change? If the current market price decreases, what will happen to the yield to maturity? Can you just tell me very quickly? Okay, first one, second one, right? Current market price increases. See, in the formula, where do you have the current market price? We have it in the denominator firstly. In the numerator also, sir, how can we say will it increase or decrease? In the numerator also we have, but we have a negative sign in front of it. Okay, so because of the negative sign, if the current market price increases, the yield to maturity will decrease. Again, we have it in the denominator. As per your mathematics, I hope you know a value in the denominator, if it increases, the main value which is calculated, that will decrease. Okay, so there is an inverse relationship between market price and yield to maturity, right? We know that when this is increasing, this is going to decrease. When the current market price will decrease, the yield to maturity will actually increase. What did we see was the relationship between the current yield and the current market price. The same relationship is there with yield to maturity also. There is an inverse relationship for sure. Okay, is that clear? Now we will be moving ahead. This is a comparison of the different terms that we have discussed till now. Bond price, also called as current market price. Then we have the interest rate, coupon payment, and yield, overall return that we are getting. We will just compare three of these. Yeah, with this our discussion on this topic will be very clear, right? We'll just discuss the relationship and I'll give you a short break. Is that okay? So here we have bond price, right, which is the current market price. Just try to visualize. Interest rate, here we discussed at the beginning, that is a coupon rate. And yield is something that we have discussed. Two kinds of yields. What are those? Current yield, and we have the yield to maturity, right? Yes, of course we do have to consider bonds is such a topic wherein you get many questions, so we definitely have to go through this formula and all. Now if I again ask you, this interest rate, yield, and bond price, we have seen the relationship. Which kind of relationship? Inverse or direct relationship? Can you just tell me quickly in the chat box which one is right over here? Yield and bond price relationship we have seen. Yes, it is inverse. One will increase, other will decrease. Now what about the relationship between interest rate and the bond price? Is there any relationship between them? Coupon payment, interest rate, and bond price. We will have a look at that also. Let me just give you an example. Yes, I thought you will say direct, so let me just give you an example and take you through this particular concept. Here we have bond A. See, what does bond A provide? 1000 rupees par value and interest rate is 10% and the bond price is 900. Now I am giving you an option. Okay, just discuss with me. A is one bond and B is another bond. Here again 1000 rupees, the bond price is same but interest rate is 11%. Okay, which one would you want to buy? Let us say already I, Surinder, I have bought this particular bond. Do you want to buy this bond A from me, or would you go for buying bond B? Please tell me very frankly in the chat box. Somebody who already okay, sir को थोड़ा help कर देते हैं, that type of mindset, you can buy my bond. But yeah, most of you would be going for what gives more returns. Arey kaun chodo. Right? So you will buy the bond B, isn't it? Yes, you will buy bond B, isn't it? Now just tell me, I have already bought bond A, and in the market the interest rates were 10%. Now it has become 11% in the market. But I also want people to buy my bond. Okay, how would you people agree on buying bond A that I actually already own? Can you just give me any idea that I can implement so that you can buy my bond also? Okay, is there anything that I can vary in my bond and you buy my bond also? Okay, what can I do? Can you just tell me? Yes? Yeah. सबसे बड़ा रुपया. Okay. Yes, very good. Most of you are giving the right answer. Pragya, there is definitely relation. That is what we will see. Okay, we'll see now. Yes, we will have to discount this bond A, isn't it? I will have to reduce the bond price. Now I say, see what bond you are buying, bond B, it actually entails 11% interest is being given over here, but the bond price is 900. I am giving you very heavy discount this time. I am just reducing the price to 800. Okay, not that heavy, but yeah, I am reducing the price to 800. Will you want to buy this bond A? Okay, let's say people still are not agreeing. Would you want to buy this bond A now? Let me ask you people. You all have agreed. Okay, very good. So I have reduced the bond price to 800. Now what can I say? If the market interest rates in the market, okay, the coupon rates in the market increase, what is happening to the bond price? Okay, in this manner, what kind of relationship is being established over here? Can you just tell me very quickly? Inverse or direct? Can you just tell me very quickly? Yes, there is an inverse relationship. Can you see this? If the interest rate in the market, we are not talking about the change in the interest rate of this bond. I hope you must have thought in that manner, because we cannot change anything here. But if in the market, interest rate in the sense changes, if the bond coupon rates in the market are changing, interest rate is changing in the market, in that case what will happen to the bond price that of the bond that I am holding? It will decrease. Okay, isn't it? Now let us say in the market there was this bond. Let's forget this one. There was a bond with let's say 8% interest. The market interest rates is 8%. Everybody is giving 8% only. Okay. In that case, Surender, I have this particular bond with me. Now I think some of your questions will be answered. Many of you asked, why would anyone buy a bond at premium? Okay, so if this is at 8%, now what can I do with this bond price? I would be putting my collar up and I would say, okay, I have a bond which is giving 10% interest. Do you want to buy? Okay, you all people might say yes. Then what will I say? Okay, the price is changed. In which manner? What will I do with this price? 900. So let's say I will make it 950, or I could go beyond the coupon value also. Okay, I could go 1000. I could go 1050 also. Okay, based upon the market conditions, right? I will increase the price. So as the market interest rates are dropping, what is going to happen to the market bond price? It is increasing. So there's an inverse relationship here also. Can we visualize it very quickly? Let us just have a look at this, right? So yeah, we remember this yield formula. At this very table, very quickly, the bond price, interest rate, yield, what can we say? If I talk about bond price and bond price, of course, bond price and interest rate, they are inversely related. One will increase, other will decrease, isn't it? Now in the other hand, bond price and yield, what is the relationship? One will increase, other will decrease. Again, inverse relationship. Bond here, if you talk about interest rate and bond price, what is the relationship? Inverse relationship. One will increase, other will decrease. Now on the other hand, if you talk about interest rate and this yield, okay, yield, always you see in the yield formula, what is there? Coupon by whatever current market price, current yield into 100%. This is what we do. So this coupon payment is always in the denominator. So there is a direct relationship between interest rate and the yield. Can you visualize that also? Okay, please do tell me. Right, if one increases, the other also increases. If the coupon payment increases, your yield or the total profit is also going to increase. Here yield and bond price again have an inverse relationship. One increases, other decreases, while on the other hand the yield and the interest rate again have a direct relationship. Are you able to visualize? Is this entire table clear to you? If CMP will be high, can we sell the bond at premium? Yes, that is what we are doing. If the CMP is high, that means we are selling the bond at premium. Okay, so this was the thing we had to to discuss. And if we talk about yield to maturity, the same thing follows. Can you just tell me if the bond price, with the bond price, which kind of relationship yield to maturity has, direct or inverse? What shall I circle? Please tell me very quickly in the chat box. Yield to maturity and bond price, which kind of relationship is there? Yes, there is an inverse relationship. With the coupon rate, which kind of relationship is there? You can see the coupon rate is sitting over here in the numerator. Direct or inverse? What shall I circle? Direct. Okay, so here is your summary. Price of the bond is inversely proportional to interest rate. Price of the bond is inversely proportional to yield. Yield are directly related to the interest rates. Okay, is that clear? So here is your break. Next we will talk about the bond price. Is Ria, is your doubt clear? If you have any doubt, you can keep putting them in the chat box. Let's take a 7 minutes break, okay, till 2, and then we will restart. Okay. Okay, let's restart. पूरी चिट चैटिंग चल रही है. हाँ, shall we restart? Okay. Right, I hope you all are energetic, back in action, right? So let's come back. Yes. Okay, हो गया. चलिए, ब्रेक टाइम हो गया. कंटिन्यू करते हैं. 6 मिनट का नैप हो गया आपका. चलो, बढ़िया है. Now let us move ahead. I hope it is clear over YouTube also. The people who are on YouTube, you can please tell me. Here we are moving ahead and talking about the bond price. Okay. बॉन्ड प्राइस किस तरीके से डिसाइड की जाती है, या फिर जो रिटर्न्स है उसके बेसिस पे बॉन्ड प्राइस को हम किस तरीके से विजुअलाइज कर सकते हैं. ओके, हाउ कैन वी विजुअलाइज द बॉन्ड प्राइस? दैट इज व्हाट वी विल सी. So if we talk about a bond, what are the different things that we can say in when we compare the bond price and the par value? First thing is premium. Okay, bond can be at premium. How can we say that the price of the bond is higher in comparison to the par value? Let's say 1050, but the par value is 1000. Okay, the other thing is it is a discount. Let's say it is selling at 900 while the par value is 1000. While it can also be at par. Okay, we also call that bond to be at par. Okay, when we say that? When the par value is 1000 and the bond price is also 1000. Okay, so these are the three conditions, three different prices that we can visualize. Okay, yes. On Monday there won't be any sessions on YouTube. Finance का नहीं होंगे, right? You can join our course. Link is in the description. हमारा बढ़िया RBI Grade B का crash course we have. We also have the gold and the silver course. I would say go for comprehensive, wonderful courses before the exam and prepare well for the exam. Okay. So from Monday we won't have. Everything will be on Zoom, right? So here, if we want to visualize the bond price, okay, if we want to talk about this bond price, generally we take that whatever future payments are coming to us, all of those future payments actually account for the bond price presently. We use the formula present value. Okay, we use the formula of present value, right? अश्विनी गोल्ड लिया है, 1 साल पहले था. Please concentrate on the session or be ready to answer questions. Okay, so if I ask questions, you should not right, you should give the right answer. Okay, ready है उसके लिए, then you can talk. So here we are talking about bond price. So we say whatever future cash flows are coming, all of those are discounted, and then whatever we can say is the present value that we have calculated, that present value is taken to be the bond price. Many of you must have thought, how do we calculate the bond price? How do we visualize the bond price? What should be the price of a particular bond? That is visualized based upon this particular thing. Now tell me, let us say you are getting these coupon payments. Okay, let us just take the same bond that we were talking about, same bond 1900. Here we have 10%. What are the cash flows that we are going to get at the end of first year? What are we going to get? Please tell me once again very quickly. Okay, at the end of first year we'll only get the coupon payment 100. Are we going to get back the maturity amount? Okay, are we going to get back the maturity amount? I am writing coupon payment as C. Are we going to get back the maturity amount? No, nothing. So at the end of second year, what are we going to get? Because the tenure is 2 years, I said, so coupon payment will come. How much will it come? 100. Are we going to get the maturity amount also? Okay, please tell me here. Who's writing 10? 10% of 1000. Okay, 10% of 1000. What is the amount? 100, isn't it? Yes, we'll get the maturity amount also, 1000. Is it clear? So what are the total cash flows that are going to happen in the future? One cash flow is the coupon payment after 1 year. Okay, and the other cash flow is coupon payment after 2 years plus the maturity amount after 2 years, isn't it? That is the total cash flow that is going to happen. Now all of these are to be discounted back to the present, and all those values have to be added to get the present value of that particular cash flows that are happening in future, and that actually accounts for the bond price. The price that we can fix for the bond right now is dependent upon what are the payments that the bond is going to give in future. Okay, so this keeps varying. Now if I talk about this coupon payment that is being done after 1 year, how shall I discount it to present value? Okay, let's recall, present value is nothing but future value divided by 1 plus r whole to the power of n, isn't it? So here what can I say? I can say that whatever is the thing that we are having over here, the payment that is we are having over here, which is the coupon payment, that divided by 1 plus r. Okay, and this cash flow is coming after how many years? 1 year. Can I write it as 1 over here? Okay, now if I talk about the other cash flow, same coupon payment is coming after how many years? 2 years. So what shall I write? 1 plus r whole to the power of what? Okay, here after 2 years we are getting this amount, so 2. And if I write over here, this maturity amount is also coming after 2 years, so I can write over here also 1 plus r whole to the power of what? 2. Can I write it like that? So if I add all of these future payments, okay, if I add all of these future payments, then we say whatever value is going to come, that is used to decide the bond price. Okay, presently what will fix the bond price? All of these values are actually utilized to do this calculation. Okay, is that clear? So do this calculation, do this calculation, do this one, and then finally calculate what will be the bond price. Isn't it really a very cumbersome task? Okay, here we have a task. This is just for 2 years. If we had payments for 10 years, how would we do? It would be really large calculation, isn't it? So that is why we have a simplified formula. This is a typical case of series again. Like we had the formula for annuities, here also we will be having another formula. I'll show you that formula. But before moving ahead, I would just like to ask you, if at all this bond were a zero coupon bond, how would the formula modify? We have 3 terms, term 1, term 2, term 3. Okay, how many terms will be there? Okay, finance itself. Okay, let's try to break it down and make it easy, but of course this formula is cumbersome anyway, right? So zero coupon bond, so in that case we have normal bond, we have the bond price, wherein we will be writing term 1 plus term 2 plus term 3. Okay, if we have a zero coupon bond, in that case what terms will be there? Can you just tell me? For bonds you will have to. Okay, can you just tell me what will be there? Which terms will be there? 1, 2, 3. Out of these, which terms will be there in the zero coupon bond? Only third, isn't it? So in the exam in RBI also, only the numerical for calculating zero coupon bond price has been asked. So they have kept it simple till now, but if they make it difficult, we should be ready for it. So m by 1 plus r whole square, only this term will be there. Why? There are no coupon payments. C value is 0 here, C value is 0 here. So first term will not be there, second term will not be there in zero coupon bond. Only the maturity value will be there. So we will have only the third term, m by 1 plus r square. Is that clear? So let us just try to after this discussion, let us just try to visualize our bond price. So is this formula relatable to you now? Okay, bond price is nothing but C by 1 plus I plus C by 1 plus I square till n number of years plus m by 1 plus I whole to the power of n. Okay, now I think this formula is very much relatable. Now what we will do is we will simplify this part, and that has been done for you already. You just have to remember the formula. Here we have simplified formula, which is C into, okay, 1 minus this thing can be written as 1 plus I whole to the power of minus n by I plus m by 1 plus I whole to the power of n. Okay, for bonds I can't help it. You will have to remember the formula, right? 1 minus 1 plus I whole to the power of minus n. Since it is in the denominator, if we take it to the numerator, we can write it as whole to the power of minus n. I hope you know this. And all of it divided by I plus m by 1 plus I. Okay, 1 plus I whole to the power of n. So this is how you calculate the bond price. C into all of this value and then this. Okay, this is the formula for the bond price if they have given all of these values. Now we will do some calculations also, we will see at that time. Now zero coupon bond, this formula will modify. In which manner? Bond price for zero coupon bond, this C is not there because the C value is 0. It will modify to how? M by 1 plus I whole to the power of n. Do you agree? For the zero coupon bond. Okay, so there is a formula for the perpetual bond also. Okay, we will talk about that formula also, right? Perpetual bond keeps giving you continuous returns. Okay, we'll talk about that also. There is no maturity amount that you might be getting or in the near future, so we do not go for calculating that. We'll see how the formula for that is. For now the bond price formula is this. Okay, what is it? We only have to remember this term, 1 minus 1 plus I whole to the power of minus n by I. Okay, this multiplied by C plus m by 1 plus I whole to the power of n. This you will remember, this term you will remember. Only this one is something that is you will have to work hard on. Okay, now let us move ahead and do our rapid fire round. Are you ready for this? Okay, let's do some calculations also. Let's have a look at which kind of questions can be coming in the exam. Here is your first question. Let's quickly answer this question. In most general sense, what is the assumption one has to make while calculating the yield to maturity of the bond? Okay, what assumption has been made? I gave you some assumptions, two assumptions separately. Yeah, okay Pradeep, that is for you to calculate. For premium case, what will be the profit? Okay, what is given over here? In most general sense, what is the assumption one has to make while calculating the YTM of the bond? Here we can see option A says it assumes that the money which received in any of the years is not reinvested in subsequent years. Assumes that the money which is received in any of the years is reinvested in subsequent years at the rate equivalent to yield to maturity. It assumes that the money which received in any of the years is reinvested in subsequent years at the discount rate. Okay, assumes that the money which is received in any of the years is reinvested at the rate equivalent to the cost of capital. Okay, so yield to maturity itself is the rate at which this reinvestment is done, so that is why B is the right answer. Let me just show it to you over here. What is happening? Please try to understand this formula. C by 1 plus I whole square, all of these actually have a base in which particular kind of interest calculation? If I ask you, is it simple interest or is it compound interest? This formula that we came about with present value, future value formula, all of these have base in simple interest or in compound interest. They have the base in compound interest, right? So compound interest actually says, well, how is it different from simple interest? If you recall, in compound interest, the interest amount is reinvested, isn't it? Interest amount is reinvested, right? And the rate at which this amount is invested again is something which is given at the bottom, isn't it? That rate percent, we write it over here, 1 plus R, 1 plus I, whatever we say, isn't it? So since the formula has a base in what? Compound interest, here also while coming up with the formula for the bond price, we are actually assuming that the reinvestment has been done. Also, if we move ahead, the interest rate that we are talking about here, empirically it has been proven that this is nothing but the yield to maturity. That is nothing but the total profit that you are going to get. Yield to maturity, what we have calculated using a different formula. The interest rate that we are talking about over here, I. Okay, I did not tell you about I. So this I is not the coupon interest rate. Coupon interest rate is different. You just use that to calculate the coupon rate. But the I over here is different. It is the yield to maturity or the yield percentage that we are actually taking into consideration over here. Right? Yield is nothing but the rate at which the investment is done again. The interest amount is again invested. Okay, of course it would be difficult to visualize all of this, but just recall that we have discussed in compound interest that the interest rate is invested at the same rate, right? So here whatever rate at which this reinvestment is done, yield to maturity, is that particular rate. Okay, and the bond price formula actually gives you an idea that yeah, this reinvestment thing has been taken again serious, and here compound interest is something wherein the base of this formula lies, right? Is that clear? So I that we are talking about over here is nothing but the yield to maturity. We just assume that at a particular rate of interest the reinvestment again and again it is done and the profits are generated, right? And that rate is yield to maturity, and that is what is talked about over here, and almost all of you have answered it absolutely right, that the rate at which this thing is happening is nothing but the yield to maturity. And I think the point goes to Piyush over here. Congratulations. Is that clear? Yield to maturity, the reinvestment assumption is also clear. I think holding till maturity assumption is also clear. Both the assumptions are clear now. Okay, I hope that is fine with you. Moving to the second question, can you just try this one? Purchase of a corporate bond. The face value is 1000. Okay, that matures in 5 years. The maturity time period, or we can just write it as N, is how much? 5 years. If anyone would want to try, you can just try. The bond pays a annual coupon. Annual coupon is how much? Rupees 60. Current market price is also given, which is 950. Okay. How are we going to calculate yield to maturity formula? Does anyone remember? Yield to maturity is nothing but how to what was the formula? Here we had annual interest, isn't it? That is nothing but the coupon payment that you are getting, plus what are we doing over here? The final payment that you will be getting, the final profit that you will be getting, that is the par value minus current market price divided by what? Can you tell me? Divided by what? Then par value plus current market price by 2, isn't it? This was the formula. Yes, many of you have calculated. This was number of years n. So substituting everything, 60 rupees is the annual payment, annual coupon payment. So 60 plus par value is how much? 1000 minus the bond price right now is 950 divided by 5. All of this par value plus 1000 plus 950 by 2, average of it. So if you do the calculation for that, you'll be getting the value around 7.18. okay, rounded to 2 decimal places. Is that clear? Did everyone understand? So I think I can give the point to Krishna. Okay, your answer was near. Very good. Is it clear to everyone? How did we calculate? Yes, moving ahead. So this was the numerical. You may get such a numerical. Yeah, solve it. You get 7.1, around 7.18 is what I hope. Now moving ahead, calculate the price of the bond with a par value 1000 to be paid in 10 years, coupon payment of 10%, and the required yield of 6%. Okay. Can anyone try? Here is the formula. If you forgot.
3 बजे तक चलेगा, 3 बजे के
मेरा
बाद
3:30 4 तक चलेगा।
आ जाना।
हटो।
नहीं हम नहीं हट,
Okay.
हम हटेंगे नहीं। पापा बोल के क्या कर रहे हैं हमको?
Riya, please mute yourself. झगड़ा नहीं करना है.
हमको भेजिए।
I request everyone to please mute if you are talking with your family members. If you want to ask anything to me, you can unmute. मैं पूछता हूँ तो unmute करते ही नहीं है. Yes, please tell me the answer for this. C into 1, you have to use this formula. How shall we use this formula? C. What is C over here? You will have to take the coupon payment, 10% of 1000. What is that? 100, isn't it? C value into 1 minus 1 by 1 plus I. Okay, of course I is what? 6%. So you will just write it as such, 0.06, isn't it, to the power n. What is the n? Number of years over here. It is given as 10 years. Okay, write that 10 years divided, all of this divided by 0.06 plus what are we talking about when we say m? Okay, m क्या है यहाँ पर? 1000. 1000 divided by 1 plus 0.06 whole to the power of n. Now what is this n over here again? 10. Okay, solving all of this you will be getting a value, right? I hope some of you have done. Only Hamare Krishna and Piyush have done this calculation, and absolutely the correct answer over here is 1294. The par value is 1000 while the bond is being sold at 1294, which is at premium. Okay, can we say that? So Krishna is actually getting the point for this. Also, I hope you have been able to understand. Yes, very good. Adarsh and Kashish also. The answer is correct, right? Yes, karna padega. Right, this is the formula. What can I do? Okay, Yoganshi and others, is that clear? बॉन्ड प्राइस एटलीस्ट प्लीज रिमेंबर, कुछ नहीं तो आपको बॉन्ड प्राइस का फॉर्मूला तो आना चाहिए, ठीक है. दिस वन एंड अदर वन इज द जीरो कूपन बॉन्ड फॉर्मूला. Okay, if you remember, this zero coupon bond formula is very easy. Now let's see this. Calculate the price of a bond with a par value of 1000 to be paid in 10 years. Okay, coupon rate is 10% and the required yield is 12%. Okay, in the previous one we said that annual payment is being done. Now if we assume the payment is being done semi-annually, then what is going to happen? Okay, they'll throw you out of the exam hall, they may debar you also. Don't do these things, right? Yes, very good. Pradeep's answer is also very good. Pradeep is also going to get the point. Wonderful. On YouTube also, I would request everyone to please pay attention. Now also the question is not visible. Is it visible now? Pradeep, please tell me. नहीं ले जा सकते अश्विनी. Right, just tell me what will happen to the rate percentage over here. When we say semi-annually, what is going to happen to these rates over here? And what about the time period? Can you just tell me very quickly? Coupon rate will be how much? Semi-annually, it will be by 2, it will be 5%. And what about the yield? It will be how much? 6%. Can I say that? And the time period will multiply. Okay, I am just showing you the calculation. Time period is 10, it will become 20. So substituting everything in the formula, we are going to get what we have over here is 1000 pay, 5% coupon, so you are going to get 50 rupees. Okay, the coupon payment will be 50 rupees. Got it? Then the yield over here is 12% given, so by 2 will be 6%. So we have taken that, and the time period is 10 years, so this will become 20. I hope you remember, into 2, so 20, and all of these we have substituted over here, right? Substituting, you will get a value of 885. It is at discount. Okay, $1000 while it is being sold at 885, that means it is at discount. Okay, no one to answer this? Not fully. Okay, okay, this part is getting cut over here, I understand. Just give me a second. Is it fine now? Yes, if you are able to manage, you will attempt, or else you will leave. Or if they have given the value for it, you can go for it. Otherwise, I would say, if such a question comes, please leave it. जीरो कूपन बॉन्ड का आ रहा है तो करिए. इफ यू आर एबल टू मैनेज दैट कैलकुलेशन क्विकली देन फाइन, अदरवाइज आई वुड से रहने दीजिए. इज दैट ओके? इफ यू आर एबल टू get the time, then go for it, otherwise no. So mostly questions like this have come. Zero coupon bond पे आए हैं, that is why, because that is very difficult, cumbersome, as I told. So here zero coupon bond, what you will have to do, the answer is around 1361. Simply maturity value 2000 divided by 1 plus r whole to the power of n. Okay, the time period over here is 5 years. R is 8%, to 1 plus 0.08 to the power of 5. 1361 is something that you get. Okay, is that clear? So I think the point for this goes to Nilesh. Very good, Nilesh. Now moving ahead, Nilesh. Okay, this one. Please tell me quickly what will be the answer for this. Yeah, RBI will provide a factor, it will provide some multiplying factor with the coupon rate. Okay, with coupon rate directly you'll multiply and you'll get the answer. It will provide that. Please do not worry. Yeah. So here option A 1000 by 1 same thing 1.08 to the power of 3. Okay, that will give you 793. A as the right answer, and I think here this has been answered first by our Piyush. Piyush gets the point. Now moving ahead, so perpetual bond also has a formula. ऐसा नहीं है कि हमारे पास नहीं है, we also have a formula, that is coupon payment divided by rate percent. We thought that perpetual bonds formula would be more difficult, but the formula is easy. They have made it empirically easy for you. So C by R. Okay, not so much of logic on this. If a question comes on perpetual bond, we'll directly use this formula. C is what the periodic payment of the bond, and R is the discount rate. Okay, discount rate or the yield percent that we were talking about. You just have to do this, and then you will be getting the answer for the present value or the price of the perpetual bond, C by R directly. Okay, so that is what you can do here. If we see an example for this, if let's say there is a bond that pays 10,000 per year, coupon is this much, so and the discount rate is 4%. So in that case, what will you do? 10,000 by 0.04, and that will be the present value. Perpetual bond is something like this, very easy calculation. Perpetual bond, zero coupon bond आया तो छोड़ना मत. Remaining if you are able to do, fine, otherwise RBI will definitely give you a multiplying factor. Okay, see, you have to multiply it with the coupon rate and then you'll get the answer to that. Okay, so this is how perpetual bond works. Now moving ahead, there is another term, representation of the bond prices. Now just answer this question to me. Let us say here we have Neil, he is selling his bond, whatever he had, to another person. Let's say some other friend of him has come and he's selling this bond to him. So here Neil is saying that, okay, take this bond from me, and he is quoting a certain price to him, right? Quoting some price to him. So he says, okay, I have bought it at 900. We saw he bought this bond at 900. Let's say he's selling it at let's say some higher price. Okay, and we have to decide for him what will that higher price be. Okay, will you help him? Well, help to decide this price? Yes. So here what is happening? Let's say every yearly basis, the coupon payment that he is going to get on this particular bond is 120 rupees, right? Neil held this bond for 3 months, right? Now he is giving away that particular bond to this other friend of him. This friend, at the end of every year, this 120 rupees will be coming. Okay, 120 rupees as a coupon payment will be given to the bond holder. Okay, at the end of first year he took, second year, third year he has sold it to his friend. So what will happen? At the end of this next year, let's say 2026, at the end of this 2026, he will be getting how much? Can anyone tell me how much is he going to get as a coupon payment? Every year I said there is some amount that he is going to get. At the end of 2026 also, he is going to get a coupon payment of what? 120. Yes, Nilesh and everyone, I hope it is very clear. But out of this 120, does he deserve the entire 120 himself? Neil actually sold this bond after March. At the end of March, let's say he sold this bond, and all the 120 is being taken by this particular bond holder. Does he deserve the entire 120? What do you say? No, isn't it? So out of 120, how much should Neil get? What part should Neil get? He held that bond for 3 months, and remaining this particular person is holding. So how much part should Neil get out of this particular 120? That is something which is decided based upon the bond days. Okay, based upon what? Based upon the bond days, this particular thing is decided. How many days did Neil actually hold this particular bond? He held this bond for 3 months. Each month we assume that there are 30 days. So total number of days how much that this Neil held this particular bond was how much? Can you just tell me very quickly? Each month we assume to have 30 days. A total number of days that Neil has held this bond, what can we say? It is 90 days. In the entire year, if there are 30 days in each month, then how many days will be there in the entire year? There will be 360 days, isn't it? We don't go for 365 for simplification of calculation. We take it as 360, right? So now if I want to calculate how much is Neil's part out of it, I can say 1 by 4, 4 cancelled out, it is 30. Okay, so Neil will say, okay, wait, I bought it at 900, I will give this bond to you at 930. Is it fine? Okay, while selling itself, Neil has added that particular price to the bond. Is it fine at the part of Neil to add that 30 rupees while selling in March this particular bond? Do you agree with him? Can you just tell me in the chat box, yes or no? So here what is happening, this price, if Neil had sold this bond at 900, that would be called a clean price. What would it be called as? Clean price. 930 is actually called a dirty price. Okay, dirty price. Why is it called dirty price? Because you are adding before the profit of the bond is being obtained by this person, you are adding that price and taking your part. 30 rupees was something that Neil actually deserved, so he's taking his part. That is called the dirty price. 900 is the clean price as it is market price, but he's adding 30 rupees which he actually owed and he's selling that bond. That is called the dirty price. Okay, and generally we consider 30 by 360. This is called the bond days. Okay, what is meant by bond days? Number of days in a month. For calculation purposes, in 1 month we consider 30, in a year we consider 360. Is that fine? Is it understood? Clean price and dirty price, is it understood? So the bond days over here is 3 months, or you can say 90 days. Okay, is that clear? So yes, so we represent the bond and we calculate the clean price. Clean price wherein this particular amount, this 30 rupees is called the accrued interest. What is it called? It is called the accrued interest, 30 rupees that we calculated. If we do not add it, it is called clean price, excluding the accrued interest. If we include it, it is called the dirty price. Okay, what you are doing is already you are adding things up even before the benefit is obtained, and that is why it is called dirty price. Is that okay? Dirty price is nothing but clean price plus accrued interest. Okay, so this is what we are doing. Now moving ahead, there are certain properties with respect to the bonds. There was this person called Burton Gordon Malkiel. He gave some properties, right, and we will just discuss them very quickly. And these properties are very much generic, you will be able to understand them very easily. He gave these in his book called A Random Walk Down Wall Street. This was his book. In this famous book, he gave all of these properties. 1932 is what he was born. He is an American economist and writer. So let us see these Malkiel's properties of the bonds. First property is something that you already know. Do you know it? There is an inverse relationship between market interest rate and bond values. Okay, so market interest rate, bond value in the sense bond price. Okay, do we not know it that market interest rate and the bond price, they have an inverse relationship? If the interest rate in the market increases, then we will have a decrease in the bond price, right? We already know this first property, done for us. Second property is that the relationship between interest rates and bond price is inverse. Okay, we already know this, but it is not a straight line but kind of a convex. Okay, it is not a straight line, it is a convex is what is being told over here. Just think in a general sense. You are a shopkeeper. Now I ask you, now I say that अरे देखो market में prices सब increase हो रहे हैं. What would you do? You would also अच्छा I will increase the prices. You would be very happy to increase the price. Let's say 100 rupees. You are very happy to increase it to 200. Now if you tell the shopkeeper, अरे market में तो ये price है, why are you giving it at 100 rupees? Okay, the price is just 50 rupees. You are giving it 100 rupees. ठीक है, I will reduce it to 90. You're reluctant to reduce the price, but you're very happy to increase the price. This is a general tendency with everything. Same thing with the bonds also. Okay, let us read the statement very quickly over here and also see how this variation in the price. Okay, I will say wahin se le lo. When interest rates fall, bond prices rise a lot. Okay, there is an inverse relationship. Interest rate in the market is falling, bond price has to rise, and this rise will be too much. Okay, because people are really ready to increase the prices. But when the interest rates rise, what should happen? The bond prices have to fall, but this fall in the bond prices is very small, and that is represented with a curved line. Otherwise this line had to be, the relationship had to be like this. Okay, but it is curved because of this variation. When there is an increase in the price, people are happy to increase, but when there is a decrease in the price, they don't want to reduce the price. They say wahin se le lo. Okay, like her Ashwini Singh. Is that understood? This is also something that we have understood very clearly. linearly. Is it fine? So it is a convex kind of a relationship, right? Moving ahead, that was the second property. Now third property is that longer the time to maturity, greater the change in its value, more is the sensitivity. Like if you ask a old person, let us relate it to very generic things. Old person, अरे आपका experience क्या है? So he will start and he will not stop, isn't it? I hope you know भिड़े हमारे ज़माने में, right? So we know people who are slightly old. Of course, they have a whole lot of experience, they have a whole lot of knowledge. Of course, we respect that, but we know that they have seen life much more than what we have seen. In the same way, if we have a bond that is having a 10-year maturity, so it has seen the market much more than what a bond of 3-year maturity has seen. So that bond of 10-year maturity is more sensitive. If at all there is any change in the market, the 10-year maturity bond price will be changing much more faster and better. Okay, the prices keep changing for the longer term bonds much more better, okay, in much more sensitive manner. That is the thing. If at all there is a change in the interest rate in the market, then this particular bond price will actually keep changing, isn't it? It will change much more for a higher tenure bond. Is it clear? Third property, is it clear to you? Yes, when they start discussion, yeah, we don't know where we have gone. In the same way, the 10-year bond actually has seen the market much more, so its sensitivity is more. What is meant by sensitivity? Can anyone tell me over here what is meant by sensitivity of a bond? What am I talking about when I say sensitivity of a bond? Degree of change of the bond price specifically. Okay, I'm talking about the degree of change in the bond price specifically, right? So that is what is the third property. Generic terms understood. Now moving ahead, we can say Malkiel's fourth property, longer maturity bonds exhibit greater convexity. Same thing we are extrapolating. Okay, 30-year bond will have greater bent in its sensitive graph. Okay, if you draw a graph, its changes will be much more convex, much more teda meda, as we can say in Hindi, right? So 30-year bond has a much more convexity in comparison to shorter tenure bonds, definitely, because it is more sensitive. Again, the same thing. Now moving to the fifth and last property, you can see this, visualize it through this picture over here. What are we having? Let us say there is a bond which is having a coupon of, let's say, 15%, right? And there's a bond which is having a coupon of 8%, right? So this bond, 8% bond, is actually floating तैर रहा है ये in the entire ocean of change of interest rates. Okay, so it is very difficult for this 8% bond to survive, right? But in comparison, if you go for the high coupon bond, it is actually आसमान में already it is flying away, right? So we can say it is not affected much by the change in the interest rates in the market. So which is more sensitive in this case? What can we say? Yes, it is flying in the sky. So we can say high coupon bonds are less sensitive to change in the interest rate. Do you agree with this statement? Is there anyone who does not agree with this statement? Just looking at this picture, are you able to understand? Please tell me very quickly in the chat box. Okay, do you agree with this statement? High coupon bonds, they are not sensitive, they are not affected because of the changes in the interest rate. This ocean, they are not affected, they are already flying in the sky. Because the coupon is high, everybody is wanting to buy and they are having good amount of demand. But this low coupon bond actually has to struggle in the market. Okay, yes, lower hurdles are there. That is the reason high coupon bond survives much more better and the sensitivity is less. It does not has any variation in its bond price just because of having a high coupon. Clear? All the 5 properties are clear. Actually, these are very deep and like that, but we have tried to understand it in very easy manner. Okay, so high coupon bonds actually have a cushion against the interest rate changes. They do not have to make any changes in the bond price because obviously they are not in the league, above the league. Right, now coming to another topic which is called duration of a bond. Now pay attention to this topic, although not many questions have been asked, but what we will do is we'll just try to understand the concept behind it and the calculations also we will see once. So Malkiel's property 3 says longer the time to maturity, greater the change in its value, right? So if there is a bond which is having longer tenure, 10 years, right, in that case what is going to happen? If the interest rate changes, then the bond price also changes. Okay, for 3-year bond and 10-year bond, which one will have greater changes in its bond price on when the interest rate changes? Can you tell me 10 years or 3 years? Which one will have greater changes? 10 years. As I said, more experienced, more sensitive. Now if I ask you a 10% bond, coupon rate bond, and a 3% bond, which is more sensitive because of the changes in the interest rate, can you just tell me very quickly? 3%. Okay, I hope the Malkiel's properties are very clear to you. Now we know that whenever there is a change in the interest rate, the bond price changes. But in what manner the bond price changes? We do not have that idea. Okay, 1% interest rate change will be there. In that case, the bond price will decrease by how much? We don't know. So that relationship has to be established, and that is something which is done with the help of a particular concept called duration of a bond. Okay, what is this duration of a bond? For the bond, let us say, again take the same example, 900 rupees, you have paid 900, 10% interest. We are just calculating how much time will it take. We are getting various payments out of this particular bond, isn't it? Cash flows. At the end of first year, what is the payment that you are going to get? 100. At the end of second year, what is the payment that you are going to get? 100 plus the 1000 rupees also you are going to get, isn't it? Now I just want to visualize out of this. Yes, definitely I will explain, Samriddhi. If I want to visualize, by when am I getting 900 back? Total what I am getting back is 1200, isn't it? Total profit that I am getting is 1200. I just want to visualize by which time after 2 years I will have 1200 rupees in my hand. I just want to visualize it. Just try. I want to calculate that 900 by what time, by the end of what time I am getting back my 900 rupees, the principal amount that I have paid. Okay, duration gives me an idea of that. Maturity is 2 years. Well, fine. I just want to know by when will I get back my 900 rupees. It is not a real thing. It is like a proportional calculation which gives an idea of the performance of the bond. Okay, we'll just quickly have a look at how we can calculate that. But before that, our Samriddhi is asking how 3% bond is more sensitive. Just now we saw, na, here we have I showed you the picture also. High coupon 10% bond does not it is always demanded by everyone, so there is no requirement of changes in the bond price. Okay, everybody wants to buy this particular bond, so you do not have to change the bond price of this high coupon bond. But bichara 3% coupon bond, it is in the market. Let's say the interest rate 5% in the market, so in that case nobody wants to buy this 3% bond. Are you following? So you have to keep changing its bond price again and again. Okay, I'll give you at this price, please buy. You have to do that, isn't it? That is why 3% coupon bond is actually more sensitive. Is it clear? Samriddhi, is it clear? Okay. Sarojini. Okay, anyway, so that is the thing. So we'll try to understand this concept of duration very quickly, right? So let us see duration. So here if we talk about duration, we from duration we'll try to derive something called the modified duration and try to get a relationship between price of the bond and change in the interest rate. Let's say 1% interest rate changes, the interest rate in the market changes by 1%. My bond price, by how much will the bond price increase or decrease? That is what I will get, the relationship I will get by calculating something called the modified duration. But before that, to calculate modified duration, we need to have the value of duration. Is it understood? Right? Duration is nothing but, if we have a bond of 900 rupees we have spent, 10% we are getting by the end of 2 years 1200. So by what time am I going to get this amount? 900 is what I want to calculate. Okay, we cannot directly say 18 months, but yeah, we will try to do that calculation. Okay, yeah, I will try to finish it as soon as possible. By 3 I think we will close the session. Okay, so we are talking about duration. I have explained what it is. Whatever initial investment you have done, by what time are we going to get back that money? That is what we are trying to calculate. Maturity is the total time period, like 2 years total time period, but duration might be lesser in comparison to this. Okay, it might be 1.5 years, 1.6 years, 1.2 years, like that. Okay, the time period by which I am getting back my principal or the amount that I have put into this particular investment. Isn't it helping us to compare different bonds? Let us say there are two bonds. This is 2 years, same terms, 2 years, this one also. Some terms are different, but we see that the duration of the first bond is 1.5 and the duration of the second bond is 1.2 years. Which one would you buy, A or B? Can you just tell me very quickly? If you have understood the concept of duration, you can tell me the right answer for this. Yes, very good. Pragya, Kashish, Samriddhi, Pooja, Adarsh, Mahesh, everybody's answer, Tushar, everybody's answer is absolutely right. So we'll buy this B, bond B, because in 1.2 years only I'm getting back my 900. Clear? Is that clear? So it is helping in comparison of the bonds. While if you want to get a direct relationship from duration, we have to travel to modified duration and then we'll calculate the direct relationship. Now duration of zero coupon bond is how much? Can anyone tell me what is the duration of the zero coupon bond? Can you just tell me? In zero coupon bond there are no intermediate cash flows. So what is the duration equal to? So sorry, so many burps. So here duration is equal to what if we talk about zero coupon bond? Can you just tell me very quickly? No idea? Yes, very good. It is equal to the maturity, isn't it? Because after 2 years only you will get back this 1000. Here 900,000. After 2 years only you will get back this 1000. There's no chance of this money coming in between. So duration and maturity are same for zero coupon bond. Is it clear? How to calculate? Very quickly we'll see this. We have this question over here. We will do one calculation, although this has not been asked, but very properly we'll try to understand so that logically you can calculate in the exam. We will have to go for a table and all of these things, so there are very less chances of asking, but we should know the process. Suppose there is a bond with a face value of 1000, coupon rate is 10% and it matures in 3 years. Okay, duration is to be calculated over here. So what do we do in duration is, what is the method that we try to calculate this particular duration is, we just see what are the different cash flows, right? Tell me, what is this bond all about? 1000 rupees, okay, 10% interest, okay, the coupon rate over here is 10% and the time period is 3 years, okay. So based upon this, can you tell me what are the cash flows that we are going to get at the end of first year? What will be the cash flow? Can you just tell me very quickly? 100. Good. At the end of second year, what will be the cash flow? 100. At the end of third year, what will be the cash flow? Can you just tell me? 1100. Isn't it? Right? So these are the cash flows that we are going to get in future. So these are what? Future values. Can I say that? Right? Now what we are going to do, we will just discount all of these future values to the present. Okay, let us say we have bought this bond at 1000 rupees only, at par only we have bought it. So we will just discount all of these future values to the present, right? How can we discount this first future value to the present? Can you just tell me how to do it? 100 divided by, can I write it as 1 plus r whole to the power of n, right? 100 by 1 plus r whole to the power of 1. Can I write it like that? Similarly, how can I calculate the present value of this future cash flow? How can I calculate that? 100 by 1 plus r, this is after 2 years, power 2, isn't it? I can write it like that. Similarly, this I can write it as 100 by 1 plus r whole, sorry, 1100 by 1 plus r whole to the power of 3. Okay, I can write it like that. So I will get the present values of all of these particular future cash flows. Now tell me, presently I have spent 1000 rupees. So can I say this 1000 rupees is nothing but all of these: present value 1, present value 2, present value 3. If I add all of these present values, I will get I should get 1000 only. Like we have seen in the previous case, we did we took 10,500 and 5%. At 5%, if we are increasing this, if we calculate the present value, we got 10,000 only, and we knew that we have spent 10,000 only. Okay, so can I say all of them actually equate to 1000? Can I say that? Right, I can say this, isn't it? Yes. So what am I doing over here is 1000 is what I have spent. After 1 year I am going to get this much of future value. That means in 1 year, out of the 1000, this much of present value is coming back. Can I write what part of the present value is coming back out of 1000? Can I write it as present value 1 by 1000? This part I am getting back within 1 year. Can I write it like that? Similarly, at the end of the second year, what am I going to get back? 100 rupees I am going to get back. But what part of my present value I am going to get back? Out of 1000, this PV2, whatever is the present value, that value I am going to get back after the end of the second year. So I can write it as PV2 by 1000. And this third one also I can write it as PV3 by 1000. Okay, I can write it like that, isn't it? So all of these parts are something that I am going to get back in particular periods of time. This after 1 year, this after 2 years, this after 3 years. Okay, so now what I have got is, this is something which is called the weight part of 1000 that I have got, that I will be getting back the value out of 1000. Some part I will be getting back within 1 year. Okay, so the part that I am going to get back in within 1 year is what I have understood. Okay, so what time will it take out of 1 year? What time will it take for this part to come back? That we can understand by multiplying 1 year with this fraction. This is the fraction that I am getting back in 1 year. Okay, so in 1 year I will get back 100, but out of 1 year, what part of 1000 am I getting back? We just multiply that time period with this fraction. Similarly, 2 multiplied with this fraction, I will get the time period within which I will get back a part of 1000. Same thing happens with this. Okay, let us visualize it through this particular table, and it will be much more clear to you. Here what we are doing, what are the cash flows that we are going to have over here? 100 after first year, 100 after second year, 1100 after third year. Agreed till here? Till here it is clear. Now we are going to calculate the present value. Okay, present value, how did we calculate? Just try to calculate 100 by 1 plus 0.1 and that to the power of 1. Tell me what is the answer for this. Can you please quickly tell me? Yes, very good, Pradeep. Yes, you are getting 90.909. So which is nothing but 90.91. Clear? Now second one, 100 by 1 plus 0.1 whole square. Can you tell me what will be the answer for that? Are you getting this one? Can you please calculate? Yes, 82.64. Similarly, 1100 by 1 plus 0.1 whole cube. Are you getting the third one? Can you just calculate quickly and tell me? Are you getting this third one? Yes, getting that one. Okay, now add all of the three. Add all the three and tell me. You have to do it because I have actually done it. Yes, Tushar. Add all the three, are getting 1000. Now do you understand? 1000 is what we have spent. Let's say we have spent the same face value and bought the bond. 1000 is what we have spent. Out of 1000, this much I am getting in 1 year. This much I am getting in second year. This much I am getting back in third year. Do you get it? Now if I want to calculate the fraction, the part that I am getting back in first year, I will do by 1000. Is that clear? Here also I will do by 1000. Here also I will do by 1000. Isn't it? Do you agree with this? Please tell me in the chat box. Okay, the fraction, the part that I am going to get back in first year out of this 1000, that I am doing by 1000, and then I am just multiplying it with the year. Okay, that fraction multiplied with the year will give me an idea of out of 1 year. 1 year I am getting back 100. What part of that 1 year I'll get back this 90.91 is what I want to calculate. Okay, so it will give me an idea of what part of that 1 year I am going to get back this 90.91. In that way, all the weights are multiplied to the time period, and what we are doing over here, not dividing 1000 here, we are directly multiplying with the time. Okay, directly multiplying with the time period and calculating this, adding everything, and finally dividing with 1000 at once only. Okay, we are not doing it over here, dividing at once, and finally what we get the answer over here is 2.736 years, right? 3 years to get back 1200, sorry 1300 in this case, but 2.736 years you are going to get back your 1000 rupees what you have spent. Do you understand duration? Please tell me. 2.7364. How to calculate also I have told. You can go for dividing 1000 here and doing the calculation, or you can do it in this way also. although there are less chances that you'll get all of this calculation. Just for your understanding, I told you, you might get a question, duration is given, and then you have to calculate the modified duration and see what is the variation. Now duration gives you an idea, within these many years you will get back 1000. Clear? Okay, I'll definitely repeat. Now moving ahead, I'm just giving you one more term which is called modified duration. Now don't ask me from where this formula came. This is empirically derived again from the series formulas, mathematical formula that we have already seen. So before moving ahead, let me just tell you, modified duration is nothing but duration divided by 1 plus r. Okay, so 2.736 divided by 1 plus 0.1. So 2.736 by 1.1. Can you just tell me what is the answer to this very quickly? Everybody please calculate and just tell me what is the answer to this. That is modified duration, and that gives you an idea of the relationship between interest rates and the bond price. Please tell me the answer for this very quickly in the chat box. Yeah, Pradeep. Yeah, you're getting around 2.48 something. Okay, 2.487. This is modified duration. Now, what idea does modified duration give you? If there is a one, we are getting how much? 2.487. Let's take that. So let's take it as 2.49, rounding it off to 2 decimals, right? If 1% increase in the interest rate is happening, my bond price will dash by 2.487%, okay, or 2.49%. It will increase or decrease. If 1% increase in the interest rate is happening, my bond price will increase or decrease by 2.49%. Will it increase or decrease? Can you just tell me very quickly? Increase. Increase? If interest rate is increasing, bond price will decrease, na? Why all are saying increase? Interest rate in the market is increasing, then bond price will decrease. Inverse relationship. Forgot? Right? So if there is an increase in the interest rate in the market by 1%, then my bond price is going to decrease, isn't it? In the same way, now tell me, if the interest rate is decreasing by 1%, then how much will be the change in the bond price, and will it increase or decrease? Can you just tell me very quickly in the chat box? I will hope that you have understood. Yes, 2.487 is right, Pradeep. This time increase by how much? Inverse relationship. I hope you have understood. By how much? Please tell me. Bond price will increase by 2.49%. Is that clear? That is the relationship that we can establish from modified duration. Is it understood? So this is what we have discussed here. This is a calculation that we have seen. In the exam, they may not give you to calculate all of this duration and all. It will take a whole lot of duration for you yourself to calculate. It has not come till now, but they may ask duration and then ask the relationship. So this last step is okay with you, na? To calculate this last step is fine with you, isn't it? Let me give you one more question. 2.86 is the duration, and rate percent is let's take 10% only. Okay, you have to calculate the modified duration and tell me, if the bond price is increasing by 1%, what will be the change in the, sorry, the interest rate is increasing by 1%, what will be the change in the bond price? Can you quickly tell me the answer for this? 2.86 is the duration, 10% is the interest rate. Please tell me the answer for this very quickly. So you can get a question from here in this part. Some are saying 2.6, some are saying 2.96. Kashish, please calculate again. I think you will get 2.6. Okay, you have to do 2.86 divided by 1 plus 0.1. Okay, 10% is 0.1. So around 2.6 you will get. Okay, now interest rate increases by 1%. So what will be the change in the bond price? 2.6% change. But in what manner? Increase or decrease? Decrease. If the change is 2% drop in the interest rate, what will be the change in the bond price? Please tell me very quickly. You may get question like this. 2% drop in the interest rate, what will be the change in the bond price? Can you just tell me very quickly? Increase by how much? Please tell me. I'm waiting for the right answer. Let's see who catches. Very good, Krishna. So I am saying 1% to 2.6% change. 2% interest rate change will give rise to 5.2% change, na? double the change. Are you able to understand the relationship? Yeah, got it. This is what modified duration is all about. Got it? Yes. Let's move to the next one. Next is very simple, yield to call. We discussed about callable and puttable bonds. I hope you remember callable bonds are the love of our issuer, while puttable bonds are the love of the investors or bondholders, because they provide them with the certain options to give back the bond to the respective people. Now here we have, let us say normally you have this calculation of yield to maturity, but there is some bond and 10-year tenure, so you calculate it till 10-year yield to maturity, but the bond has been called back in 5 years only. So is that yield to maturity actually helpful to you? No, right? So in that case you will have to calculate yield to call. Okay, and the formula is also very simple. Same formula, yield to maturity, do you remember? Annual interest plus we did whatever was the par value minus current market price divided by number of years by par value plus current market price by 2. Okay, this was the yield to maturity formula. 10 years is the time for maturity, but it has been called back in 5 years only. Okay, callable or puttable, whatever it might be, it has been called back in 5 years only. So at that time you won't get the par value. Okay, entire par value amount will not be given. You get something called the call price. So the final profit that you are getting is call price. Instead of par value, we just substitute everywhere call price. Is it clear? Yield to call, is it clear? Okay, no doubt in this, I guess. Okay, just we are substituting because it hasn't called before itself. Now the final thing, we have something called the holding period return. Okay, so this holding period return is nothing but, let's again, the bond is of 10 years, but as you saw, Neil sold it in between. Let's say he sold it in 3 years only to someone. Okay, so at that time he has to calculate the return. He knows he will hold it only till 3 years, so he will calculate the return for this holding period, and that is called holding period return. Right, is it fine? So what he will get here is the income. Income is nothing but the coupon payment. The same type of formula, right? Coupon payment he will be getting. Apart from that, end of period value at the end of 3 years, let's say here it is 1000 rupees, let's say at the end of this period only 300 is something that he might be getting. So end of period value is 300, but he has bought this bond at 100 rupees, let's say. So initial value that he has bought it at is 100, right, divided by 100. So this is how you will be calculating all of this, right? Holding period return, all of this thing, everything divided by 100. So coupon, let's say, is 10 rupees or something. We'll do the calculation, and then you will be getting the holding period return out of this, right? Into 100%, if you do, you will be getting the value. Whatever period for which you have held this particular bond, that for that period only you are calculating the holding period return. Okay, this is not annualized, as you can very clearly see, but yeah, this gives you an idea of the total returns that you are going to get. So this holding period return is not annualized, not for yearly basis. We will have to calculate it at the yearly basis. For that the formula is slightly complicated, slightly different. Income plus end of period value minus initial value, all of this divided by initial value plus 1 to the power 1 by t minus 1. Okay, again I would say no question has been asked from this, right? But yeah, this is the formula for the holding period return, which is annualized. Annual this is calculated for yearly basis. Okay, so this is how you will have to go ahead. We'll do some questions also. Here is your Lord Simha rapid fire round. Are you ready for the first question? Here is your first question. What is given? Callable bond, face value is 1000, actual face value is 1000, pays a coupon of 10% interest. Coupon is this. The bond is currently priced. Okay, so call price, or you can, I think this currently price is nothing but the current market price, not call price. Current market price is 1175. Has the option to be called at this much. So call price is given. Call price is 1100. Okay, and the time period is 5. Okay, yield to call is something. Yeah, okay. But bond price formula you have to remember, because those questions come again and again. Okay, you have calculated what is this yield to call. How you will get that one? 10% of the par value. Here par value used to calculate only the coupon rate. So yield to call is nothing but whatever is the coupon that you are going to get plus call price minus the current market price, right, divided by number of years, call price plus current market price by 2. Okay, like that. So coupon over here is 10% of 1000 is 100 plus call price is how much? 1100 minus 1175 is the current market price by 5. 1100 plus 1175 by 2. Okay, if you solve all of this, you're going to get the answer around 7.43. Very good. Some of you have been able to do it. Yes, I think 7.43 by Krishna 47. I'll have to give the point to Nilesh. Are you able to do it? Yes, Pradeep over YouTube. Is it clear? Call price formula, is it clear? Right? Are you able to do it? Yes, 43, right. Moving ahead. So we have the answer. So what is given over here to calculate the holding period return? Okay, what we will do is holding period return. Here you have the investor buys a bond for 1060. So this is what is the price at which the investor has bought the bond and keeps it for 1 year. For 1 year he is having it with him, during which he receives an interest of 110. Okay, 110 is the interest, the profit that he is getting. So holding period return is nothing but whatever income you are getting plus the difference in buying and selling price. Okay, all of it divided by whatever is the buying price. Okay, what you have spent, that thing. The income that you are getting is 110 plus subtract these two, 1065 minus 1060, all of it divided by what you have spent, 1060. So that will give you the holding period return. So it is around 10.85%. okay, in this case. Are you able to visualize this thing? Right, so that is what is the holding period return. Just add all the values and then divide it with what you have actually spent. That is holding period return, right? So that was easy. Now moving ahead, we have two bonds, bond X and bond B, right? Can we try to calculate holding period return for both of them? Okay, yeah, this point goes to me. Holding period return for X, please try to calculate. Same thing, 100, 150, 5 rupees is the profit, 3 years is the time period. Can you just try to calculate for X? Can you just tell me holding period return is how much? Right, so 5 plus 150 minus 100. I hope you have been able to understand. And 100 is what you bought it, right? 55 by 100. In percentage terms, it is 55%. For B, what is the holding period return? Sorry, 10 plus 320 minus 200 divided by, you bought it at 200. Okay, are you able to follow? It is around, I think, 130 by 200. Okay, it is around 65, right? Yes, 55, 65. But here it is for 3 years. This is for what? 4 years. So are we able to compare both of these bonds? No. So for that we will have to calculate the annualized return. Okay, so annualized return, the formula is slightly different. Okay, I'll just give you the formula because I hope you might not remember it. So 5 plus this difference was 50 over here divided by 100. This what you will have to do is all of this has to be added to 1 and then to the power 1 by t. Okay, 1 by t is 1 by 3 and all of that value has to be subtracted with 1. Just try to calculate. If you do the calculation, you will get 15.73% annualized holding period return for X, while annualized holding period return for B would be around 13.34%. When we are calculating it at annual basis, we are able to compare the bonds. I just want to show you why annualized return. Compare the bonds. How we will be able to compare? When you calculate it for annual basis. So here for X we have this calculated at the annual basis 15.73%. So we will go for investing in X. Is that clear? Holding period return and how annualized holding period return actually helps in comparison. Okay. So for this also point goes to me. For the previous one I would consider Piyush and Nilesh. Okay, good. So those were our technicalities. Very quickly let us have a look at the risk. So first risk is call risk. You thought the bond you are going to hold it till 10 years, but you have a option of calling it back. So this bond has been called back in 5 years itself. So you thought you will be getting your income, steady income till 10 years, but you did not get that steady income till 10 years, till 5 years only. So that is a risk itself on the income that you were expecting, isn't it? Do you understand what is call risk? Call risk is issuer getting this particular, no, this is not right, issuer getting the option of actually calling that bond back. Okay, then credit risk is that issuer actually defaults on that particular bond. Okay, credit risk means what? Default. This is also called default risk at some time. Okay, this is also called default risk, which means the bond is the bond is expected to give 100 rupees as a coupon payment. This is not given. At the end of second year, 1000 rupees par value has to be returned and 100 rupees coupon payment, that is also not given. So this default is something which we say is called the credit risk. Okay, you have to match these. Sorry for that. So this credit risk is issuer of the bond will default. Call risk is redeem whenever there is a callable bond and it is redeemed back. Now moving interest rate risk, there is this fall in the interest rate. Okay, let us say in the market the interest rate is falling, the bond is redeemed and then new bond with lower interest rate is issued in the market. This will be redeemed, taken back, and new bond will be issued with 8%. So that is a risk for you, isn't it? Again the same call risk, but because of the change in the interest rate in the market, this thing has happened. Now let us say you get the profit of the bond. You spent 1000, you got 1300. This 300, where are you going to invest it? Invest that money. That is called the reinvestment risk. Okay, what happens? Previously you are getting 10% interest, but after getting this profit, now the interest rate in the market has changed. Let us say it is 8%. So now you are unable to get the 10% interest that you previously got. Okay, so that is called the interest reinvestment risk. When you are reinvesting, the interest rate is very low. Is it clear? The reinvestment is not profitable for you. Okay, Sara India. Okay, now can you tell me what is the what is meant by liquidity risk? Can anyone tell me? Let's say you have bought the bond of Sahara India, and what will happen? Can you just tell me very quickly in the chat box? Last few topics with that bond will be done. Tomorrow on Monday we'll do derivatives. Yes, I'm waiting for you. Liquidity risk, what can that be? No money refunded is credit risk. Cash flow is not smooth in the market. Okay, difficult to sell in the secondary market. Okay, you have bought a bond, junk bond. Who told you to buy? But you bought, and nobody is buying it from you, let's say. Okay, so in that case you are unable to move that particular instrument in the market very quickly, right? Difficult to sell that in the secondary market at a particular fair price. That is called the liquidity risk. Like you said, Sahara, let's say you have bought the bond of Sahara and you're sitting, the company went bankrupt. Of course you might get the payment back, or you might not get, it might say I'm very bankrupt. So in that case what will happen? This liquidity risk. Okay, difficult to sell that. You cannot sell that bond anyhow because the company is already bankrupt, or if it is not doing good also, in that case nobody will buy. So these were the risks. Okay, quickly we'll do this rapid fire rounds. Credit risk in bonds refers to what? Can you just quickly answer this question? Credit risk. Why some are saying D? Banks also face credit risk. Okay. Okay, credit risk is risk of issuer defaulting on the payments. He is not giving back the money. So here the point I think goes to Kashish. Is it clear? Credit means banks also face the credit risk. Is it clear? Who all have answered D? changed answer, Kashish. Okay. Reinvestment risk is what? Very easy. When you are reinvesting your interest payments, but you are getting lower rates. Okay, the profit that you are getting is low. So C should be the right answer, right? Again, Kashish gets the point. Last few topics, we'll see something called the balloon repayment loan. Whenever you have taken a loan and you have to pay, let's say 1 lakh rupees loan, and the entire amount you have to pay after 10 years, 1 lakh rupees at once. That is a very big problem, isn't it? Generally, what happens, you have taken a loan for buying a car, house. What you do, we divide it into installments and we pay it back with certain interest amount. So out of 1 lakh, let's say 10,000 every month, plus some let's say 900 rupees interest also you are paying every month. Like that you pay back the amount. That is easier. But let us say you are only paying the 900 interest every yearly basis, 900, and at the end again you have to make this 1 lakh rupees payment at once. That will be a big burden for you, isn't it? That is called a balloon repayment loan. Is it understood? For this, what actually happens, you can see over here, there is something called a sinking fund that is maintained by the companies. If they take such a balloon repayment loan, they maintain a sinking fund. Every month what they will do, out of this 1 lakh, in the sinking fund they will place some amount. Let's say they place 10,000 every month, 10,000 like that in that fund. And after this has accumulated, they will give that entire 1 lakh rupees accumulated at once. Is it understood? Do you understand why this fund is called sinking fund? Is it clear? You can tell me in the chat box. Okay, so paying back the money at once, whatever money you have taken, when you are paying it back at once. Okay, instead of paying it in installments, it is called balloon repayment loan. Okay, only interest payment is done and no principal payment is done. No part of the principal is paid back. That is called balloon repayment. For that we maintain a sinking fund so that we can deposit all of that amount and at once we can pay all of that money back. Yes, large financial liability is avoided by going for a sinking fund. Okay, 1 lakh rupees you have to pay at once. What we do, we maintain small sinking fund, and 10,000 every month, every year we will be depositing, and by the end of 10 years we will have 1 lakh. So that is something which is called a sinking fund. Now moving ahead, there is another kind of bond which is called amortizing bond, wherein the payments are done one by one, like a loan, wherein in installments, first year you are paying some amount, second year some amount, third, fourth, fifth year some small amount of the initial principal amount you are paying back in installments. So that is called amortizing. Okay, amortizing bond, amortizing loan, that is something wherein the principal amount is paid in parts, not at once at the end. It is just an opposite of balloon repayment loan. Is it understood? Amortizing. Then moving ahead, the we can say the definition is principal is not repaid at the end but over the life of the bond in installments, clearly. Now there are next two kinds of bonds, mortgage bonds and equipment trust bonds. Very simple. Mortgage bond, a bond is issued and you say I will pay back the money, I will give the interest, pay back all of your money. But if you are unable to do it, what is the security? The collateral is the house that you have kept as security behind this particular bond. Is it understood? That is called a mortgage bond, wherein you kept a security, right? In Australia this happens. Okay, so there is some security that is kept, and that is that security is a house. If the security is some other equipment, it is called equipment trust bond. Okay, simply based upon the change in the security, this particular bond types are, the collateral is different in both of these types of bonds. Okay, real property as additional security, here you have machinery as the security in the equipment trust bond, right? And finally, bond days is something that we have already discussed, right? 30 days and 360 days is something that we consider as standard, and accrued interest we have calculated already, coupon payment into bond days. 90 days he has held this money and 360 days is the total number of days, and then we calculated the accrued interest that can be added to the clean price to get the dirty price. I hope you remember. So those were the things. Final rapid fire, can you just try to answer this? In a balloon repayment loan, which of the following is true? Yes, very good. I hope it is clear. balloon repayment, all of the payment, principal payment is done at the end. So you can very clearly see C is the right answer. I hope there is no doubt to anyone here. Kashish gets the point. This one. Yes, second one please. No one, only Krishna. If you read this, there is 10,000 rupees paid towards the loan annually. In that 6,000 is interest, while 4,000 is a principal payment paid back. So this is not a balloon repayment, obviously. So it will be something else. What is that? It is a, yes, I think Krishna is getting the point here. It is what? It is amortizing bond, D. Clear? Now this one, we already calculated this. Coupon payment is 120. It is purchased 90 days. Okay, so 90 days he has kept it with him. The total days, number of days in the period is 180. This is what we have to do to calculate this one. How much will we get the answer for this accrued interest? Did you understand? Okay, so that would be twice and 60. So D should be the right answer. Yes, I think Nilesh gets the point over here. Yes, Adarsh, Kashish. Finally, mortgage and equipment trust bonds. What is right? C, isn't it? So real property is used as security. Yes, Piyush gets the point here. Now we move towards derivatives, which we'll do in the next class. And if you did like the session, you please can give your feedback at feedback@edutap.co.in, right? So thank you so much, and I'm sharing the PDF. Please, if you have one more minute, you can spare that time and give the feedback at feedback@edutap.co.in. Yeah, finally done with bonds. Bonds is very important, so I took some time. Derivatives is also important. We will see that on Monday, don't worry. And yeah, people who are on YouTube, I would like to say that this is part of a demo session, which is part of a course, right? We are providing for the RBI the live crash course. Also, these classes are part of the gold and silver are courses in which you can enroll, right? I'll show you those courses also. Let me once share the PDF over here, and people who are on YouTube, you will get the PDF from the Telegram channel. So let me tell you, there are no more these demo sessions that will be done. From Monday the classes will be only on Zoom. Whoever is on YouTube, you can please click the link given in the description and join these classes. Let me just quickly show this to you. Here you have edutap.in, wherein you can visit this website edutap.in, go to RBI courses and view all the courses. You can be part of the live crash course, also the silver course. Gold course is comprehensive, all the 3 phases, while silver course is for phase 2 and interview. You can also go for the test series, right? So all of these are there, edutap.in, wherein you can get these. Let me just share this PDF with all of you, and please, I would like to request, many of you have not given the feedback, right? So this is something which is very much crucial. I hope you know. So I would just request all of you to spare one more minute if you have right now, and please give your valuable feedback. People who are on YouTube, if you did like the session, you can also share your feedback at feedback@edutap.co.in. Let me just quickly share this presentation with you. Just give me a second. And if anyone wants to say something, you can tell me. Right? And if you have any doubts, you can also ask. Sorry, today's class was slightly delayed, but we'll try that. We'll keep within the time. See you on Monday. Okay, take care. Let me share the PDF with you quickly. And if anybody wants to say something, you can unmute and tell me. Right? Just a second. Just give me a second. Yeah. Yes, here is your PDF, and please, if you have time, you can share the feedback. feedback@edutap.co.in. Thank you so much. Take care. Thanks a lot. Please download the PDF. Mahesh, Piyush, Pooja, Ravi. I think this is Amit. Let's meet on Monday. Thank you so much, Kishore, Pradeep. If you did like the session, you can please let me know your feedback at feedback@edutap.co.in. Did you download? Shall I end the session? Please tell me. Yes, okay. Thank you so much. Yes, Pradeep, it is shared on the Telegram channel. You can get it from there. Okay. And again, for people who are on YouTube, I would like to say this was a demo session. You can join these classes by clicking the link given in the description and being part of our courses. Since there is very less time left, right, you can just opt for these classes very quickly. And finance is something very much important. Phase 2 is something that people miss out on, right? So preparing daily well is very important. So you can be part of these courses. edutap.in, you have to visit there and enroll into the course. I hope you have downloaded it. Shall I end the session? Allow me to end the session. Thank you so much. Let's meet on Monday. Okay, take care.